Testing, 1, 2, 3, testing. This is Kathy. If you can hear my voice, see my screen, let me know. Just type in the question box. And I was just wondering, because I can't really see it on my end, but do you see a little image of me as well talking? Say yes to, okay, fabulous. Great. I just wanted to, have this on right now so I can say hi to everyone. I'm not going to keep the video on the whole time because it's going to be a bit distracting. And let's give the late stragglers about a minute or so to log on. I hope all of you are staying healthy and staying safe. Learning how to trade is a really good way to utilize your time because the markets are definitely moving. There's been a lot of opportunity, and we hope to share with you some ideas on how to capitalize on that opportunity. Everything is recorded, and so even if you can't stay for the entire session, which is going to be 4 hours long, no worries. As soon as it's rendered, most likely by tomorrow, we'll send you an email where you can access the entire video, and then you can probably fast forward to the part that you missed. So don't worry about staying for the entire session because everything will be recorded. It is a 4-hour session, so it's a very long period of time, but everything will be recorded and then emailed to you within 24 hours. It's just that this one in particular will be a particularly large file, so it will take a bit longer for it to render. Okay, so with that, let's go ahead and get started. First, I think Boris wants to say hi before we get too into it.
Hi guys, I'm just checking in. We're gonna run the show sort of half and half. Kathy's gonna start you off and I'm gonna finish you out. So be patient with us. Any questions, of course, ask us as we go along. And I just want to say hello. If you're hearing a little bit of noise in the background, it's 7 o'clock in New York. We have a great tradition where every night at 7 o'clock in New York, we give a thanks to all the first responders and all the people who are working now during the virus period. So everybody in New York starts clapping. And it's kind of really, really nice. So the little background noise is going to fade in a little bit. And I'm going to actually mute myself out. But it's always a nice reminder of the fact that New Yorkers are sticking together in this time.
Wonderful. Okay, so let's go ahead and get started. So as I said, I want to thank all of you for joining us today. This is the kickoff to our Learn to Trade Forex, Gold, Stock Indices, and Spread Trading class. We have coined this our greatest trading course ever, and the reason for that is not only are we sharing with you the best and the brightest of our trading strategies, but we're also going multi-asset class. Boris has done a tremendous amount of work trading in stock indices and spreads, and he's going to impart with you some really good knowledge on that front that I think you'll find very, very valuable and also I hope intellectually stimulating. I know I do, but regardless, it's going to be a very rich session or a rich course in general, and this is the kickoff. We are starting with the basics, and we're starting with what we think you need to know in order to really build a foundation for trading in general, trading Forex, as well as trading all of the other asset classes. So there's a lot to learn here, and for those of you that are just joining us right now, as I said, don't worry about staying for the entire session, or if you miss any of the lessons and they're not in your time zone, everything will be recorded. Everything will be emailed to you. This particular one will take probably 24 hours because the file is so large, because it's going to be a 4-hour session. But we're going to email that to you, and you can always fast forward to whatever you need to basically pick up on what you missed. So before I begin, I'd like to share with you this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. And of course, this is true of all leveraged instruments. So if you're watching this video on demand, feel free to pause the screen, read through the disclaimer thoroughly before moving forward. So what are we going to talk about today? as I mentioned earlier, we're going to start with the basics in order to kind of build up your knowledge and hopefully, help you get a good foundation on where to start in terms of our trading strategies. We're not going to jump straight into trading strategies. We're going to have a lot of useful information for you. And we are doing it kind of reverse because we did want to give you some valuable information right at the onset. So I'm going to start off in the first half of this 4-hour class. I'm going to talk about the ABCs of trading Forex fundamentals, best trading sessions and instruments for FX, and the tips for trading the major currencies. I specialize in trading currencies. I've been trading currencies since 1999, so it's a very, very long time. Actually, before this talk began, I was pulling out white hairs from my head. So, it's been a very long time. Boris will also talk about currencies to some degree, but more importantly, he's done a tremendous amount of work, tremendous amount of work on spread trading, indices trading, and that's really what that valuable knowledge is what he's going to impart on you for most of the course. So he's going to talk about CFDs and futures tradings for newbies. The content he's going to talk about today is more structured around making sure you get everything set up in order to trade these things properly. And then in his next session, he's going to go into trading strategies on Wednesday. So, there's a lot going on. Today, I'm going to start, Boris is going to follow up, and, hopefully you'll find the information valuable. Okay, so in addition to today's class, we have 4 more live sessions. On April 15th, we're going to share with you the professional tactics for retail traders. That's when we really get into spread trading, indices trading. I want you to think Walmart versus Tesla. Those are some of the really interesting trades, Dow versus Russell, that Boris has been doing in the past few months. And he's going to tell you exactly kind of the mindset and the thought process that goes into these trades and how you can actually do them for yourselves and give you the tools in order to do them better. Then we're going to cover best strategies for trading momentum and trend. And after that, it's an intensive session and making the robots do all the work for you and showing you exactly how to use MT4, MT5, because you really need to have those tools on your side in order to be an efficient trader. And then lastly, we're going to put it all together, use our strategies to trade the next non-farm payrolls report, which is going to be huge. I mean, 700,000 last month. It's probably going to be just as ugly, if not uglier, in next month's report. So we're going to be trading that live with you and, answering any questions you have had in the prior sessions. It may be covering anything that we may have missed then we thought, that we want to share again. So to kick off, we're going to start with the ABCs of Forex fundamentals. The ABCs of Forex fundamentals is basically what you need to create the foundational knowledge for trading currencies. For those of you that are joining our BK Forex world for the very first time, even though we've kind of expanded into indices, commodities, as well as spread trading, our roots are always in Forex. And probably many of you are coming to us because you're learning about how long we've been in the market trading currencies. And that's what we're starting with. That's what we're talking about. We're talking about the ABCs of trading Forex fundamentals. So starting from the very basic, the FX market is truly the most dynamic market in the world. It is a market that, basically revolves, 24/7 and evolves and basically involves many different participants. A good way to look at this is, who actually gets involved in the Forex market. The Forex market is truly the largest market in the world. It's bigger than, about 5 times the size of, the next biggest market, significantly larger than futures markets, significantly larger than the US equity markets. And that's because there's so many participants in the Forex market. You have banks who are in there doing transactions and, basically exchanging funds from one center to another. You have central banks who are in the markets. either providing swap lines or actually intervening or do whatever, else activities they have. You have investment managers who are multinational investment managers who may be, investing in not just U.S. assets, but assets abroad. They've got to offset some of that currency risk and take some of the currency risk off the table, and they're involved in the FX market. Hedge funds, corporations, many corporations not just operate in one country, they operate in many countries around the world. And because they operate in many countries around the world, they've always got to worry about, hedging their transactions, making sure that if they have invoicing, that they kind of return those to their local currencies. So there are just so many people involved in the market aside from us. And that is why the market is so deep. That is why the market is so rich. And in fact, our own participation in the market is extremely, extremely small. Speculative flow is only a fraction of the overall volume that we have in the Forex market. And I think that's really important to remember, because when we're trading currencies, a lot of times people are asking, is the broker just trying to run my trades or run my stops? Is my position going to be clipped off because it's out there? And unless it's really, really close, oftentimes the answer is no, because it takes a lot to move the markets, and it takes a lot to move it 10, 15, 20 pips. So it's not just our positions that are dictating where currencies go. In fact, it is a lot of the other participants that are driving currency flows, from banks to central banks to investment managers, hedge funds, and corporations. At the same time, a lot of these participants can, their involvement in the market can explain some unexpected movements. Like if suddenly there's a spike in a currency, it may be due to a company or a bank needing to get through some significant M&A flow, merger and acquisition flow. So there's a lot of participants in the market that can basically drive currency flows. So I'm actually going to turn off my webcam now because it's a little distracting, and we'll just go into pure content. If you'll just give me 1 second. Okay. So what makes the Forex market unique? There's a lot of things that make the Forex market unique, aside from the depth of the Forex market. But what truly makes the Forex market unique is the fact that it's a 24-hour market. And I really like to talk about this because as we get more and more to our presentation later on, I'm going to talk about how there are unique trading tactics and behaviors of each of the individual trading sessions, and how we can basically use that to our advantage. But the Forex market is open 24 hours a day. And because it's open 24 hours a day, what's really wonderful about that is that regardless of what part of the world you're in, and many people are from different parts of the world, there's always some type of opportunity. And I'll help you, and later on we'll talk about how you can structure your trading day depending upon what part of the world you are in, and what are the kind of best trades to look for at each part of the trading day. But the most liquid trading session, the most activity is always between the New York and London sessions when they overlap, because that's when you have the greatest amount of participation. And so typically, anywhere between 6:30, I think, to about noon time, New York time, that's when you get the most participation in the markets. That's when you get the most action, and that's when you have some of the cleanest trades. But we'll get more into that later on. To start, I think it's really important to realize that we're unlike the equity market world, where we have thousands of stocks. In the currency world, we really just have 8 major currencies. And so in many ways, that kind of simplifies a lot of things, because when we have only 8 major currencies, it's not as if we need to really focus on all of these figuring out which ones have the best PE ratios, or trying to filter out, the strongest companies versus the weakest companies, and hoping that, we got the right one. With currencies, there's only 8 major currencies. As you can see from the pie chart here, even though we have 8 major currencies, the US dollar encompasses over 80% of that flow. And that is part of the reason why, how the market feels about US dollars and the market's appetite for US dollars has such a significant impact on how, how the broader market and the overall currency market moves, because it really does. On a given day, more often than not, there can be a tremendous possibility that the markets that, either the US dollar is up against everything or it's down against everything. So one of two things. And, that's good and bad. I mean, it's good in the sense that it creates a lot of clarity, either the market, it's up against everything or it's down against everything. And, you just pick a view on the dollar and just go with it. But it also is bad because of that, you have a situation oftentimes where you have very correlated trades. I mean, basically, if you have the US dollar down against the euro and down against the Australian dollar, going long euro dollar, going long Aussie dollar can be a very, very correlated trade. And I have to take that into consideration every day when I trade too, because, I oftentimes will come in with more than one position, and I need to diversify by making sure that, my positions aren't too correlated. So the US dollar is the most liquid currency, and then it is the euro. So oftentimes when I meet new traders, they will ask me, what's a good currency to start with? And a good currency to start with is oftentimes the euro/US dollar pair. And the reason for that is because it tends to, first of all, have the tightest spread. Second of all, it has the greatest amount, because it has the greatest amount of liquidity, it has the tightest spread, and you have less spikes as a result, because when you have so many people trading the currency, participating in the currency, it tends to have less spikes than if you were trading like a less liquid currency pair, like a cross, like for example, British pound against the Australian dollar, or Australian dollar against the Swiss franc. Those currencies you normally tend to have more, unexplained volatility and spikes. I know with a lot of the major currencies, you can have, kind of spike moves, but just tend to have a little less with euro dollar. I also hate that question. And I hate that question about what's the best currency to trade, is because it should not be about what is the best currency to trade. When it comes to trading, it should be about what is the best setup, what is the best trading, which pair is generating the trading signal. Now, if you were to focus only on the trading signal of one currency, then probably euro dollar would be a good bet. If you do nothing but just you're just looking to trade one currency and wait for the signals for that, then euro dollar is a good bet. But I like to focus on the strategy rather than the currency. Now, of course, currency also has an impact on that, because the spreads for different currency pairs are different. Like pound Aussie will have a much wider spread than euro dollar, even pound dollar. And so the spread and your appetite for risk and your appetite for paying that spread cost should be a consideration. So starting off, trading Forex versus stocks. Some of you may be coming from the stock world, and you may be saying, this is a new market. How should I look at it? It seems like it's a very foreign market. That's why it's called foreign exchange. It seems like, I don't know how to approach it. And I want to kind of distill some of your fears. And the reason for that is because in many ways, the way you look at trading stocks is the same as the way you look at trading, the same methodology can be used to trade currencies. And so the reason why I say that is because for those of you that come from the stock or share trading world, basically everything that moves stocks boils down to one of these 5 things. It's corporate news and earnings, economic data, interest rates, comments by central banks, commodity prices, market sentiment, and in market sentiment, I would even bucket the big stories, such as, trade war, COVID-19, things like that, the big stories. That's what moves the stock market. And that's exactly the same things with the exception of one that moves the currency market. I mean, in currencies, we do not have corporate news and earnings, but the same economic data, like non-farm payrolls, is going to move the stock market, just like it's going to move the currency market. Interest rates of the central bank increases interest rates or decreases interest rates, that's going to move the stock market, just like it will move the currency market. Commodity prices, same story. Oil will move Exxon, and it will also move the Canadian dollar. Market sentiment and the big stories, the macro stories, is going to have a tremendous, as we're seeing in the markets in general, is going to have a tremendous impact on the global markets. And that includes the FX market as well as the stock market. Like, for example, when you have a situation where the world is panicking about coronavirus and COVID-19, stocks are selling off, and by a large degree, currencies are selling off as well. So when it comes to stock trading, there are generally 3 schools of thought. You can trade the story, which is the valuation of a company, the story of a company, how good or bad it is. You can trade the news, which is the corporate announcements, the earnings, and you can trade the charts, which is technical analysis. In FX, it's pretty much the same thing with a little bit of a wrinkle. Trading the story basically means trading the economic outlook and the interest rates direction of a country. Trading the news is basically trading economic data. And with the Forex market, economic data comes out, almost every day. Particularly for the US, a little less so for some of the other countries, but pretty much every single day we have, some type of economic data released that gives us a more up-to-date look at how a country's doing. And that's tradable. And you can trade the charts because the same type of head and shoulder setup that you may see in stocks is the same head and shoulders setup, that you'll see and also trade off of in currencies. So you can trade the story, you can trade the news, trade the charts in pretty much the same way as you do in the equity markets. But in currencies, I have always been a proponent of combining fundamentals and technicals and using a fusion of both, because I feel like it would be a mistake to disregard one versus the other. Fundamentals determines the general direction and the trends. Technicals can be used to help you pinpoint entry and exit levels. I mean, for example, if you know the US economy's had a recession, you think that the US dollar is sold, it's not as if, if the US economy's had a recession, it's going to be months and months and months and months of negativity. It's not as if you can just sell arbitrarily at any point in time, hoping that's going to go down. You want to make sure you wait for the right setup. You want to make sure you, don't sell the lows. And there may be opportunities to buy in dips during that time too. And so that's where your technicals come in. And that's where your indicators come in to help you determine what's the best trade. As a rule of thumb, a good economy equals a stronger currency. A bad economy equals a weaker currency. Of course, it is not that easy. We all wish it was that easy, but it certainly is not that easy. And so when it comes to the ABCs of Forex fundamentals, what I think is the best way to look at it is the 3 M's: macro, micro, and monetary policy. And basically what this does is that this takes a top-down approach to looking at the markets, where you do start with the big story. You do start with the big themes in the markets. And then you whittle down to all the other specifics like monetary policy, fiscal policy, interest rates, inflation, and then economic data and earnings. So what's the big stories? The big stories are generally fit into one of these 5 buckets, like a political crisis, like Brexit, or some sort of sovereign debt crisis, an economic crisis like recession/depression, environmental risks like the coronavirus, geopolitical concerns such as war or even OPEC meetings, could be oil war, it could be physical war, and then trade. Trade is also a big story. And as you may be seeing, these stories are not stories that come and go on a day-to-day basis. These stories usually last for months and months and months, and sometimes years and years and years. That was certainly the case with the US-China trade war. It lasted for no less than, lasted for 3 years, no less than 3 years, and may continue to go on in the future. But these things last for a very, very long time. And whenever a country goes into recession or depression or even a phase of growth, that usually lasts for 1 or 2 or maybe 3 years, and it's hard for things to turn. Once you move the Titanic in one direction, it's hard to get it to turn in the other direction. So the big stories is basically what stays with us for a long period of time, and that's the driving force of your trades. Like oftentimes I will have an opinion on how a country will do or what a central bank will do, and then it will be my fundamental view. Like for example, I may be bearish Australian dollars because I think the Reserve Bank of Australia needs to cut interest rates and needs to maintain a dovish bias for certain reasons, and usually that outlook is maintained for a few weeks and maybe even longer. And with that view, I will look for opportunities to trade the Australian dollar in a way that's consistent with my view. So for example, if I'm bearish, and I think the Reserve Bank Australia is going to cut interest rates, and I think they're going to be dovish, I may only be looking for opportunities to sell the Australian dollar. So the big stories is what can basically drive the direction of your trades. And then you want to use technical analysis to help you identify the best entry and exit points. But it's still not that easy. It's really important to look beyond a single market. So what is single market analysis? Single market analysis means that you're just watching one thing. Either you're just watching the charts and you're completely ignoring fundamentals, or you may just be only watching one currency pair. Like you may only have an opinion on the US dollar and not on the Japanese yen or the euro. And you may lose sight, and you say, okay, I'm just bullish US dollars. You may lose sight of the of what is the other factor that could the other currency and the other factors that could make the other currency move up or down. And what I like to say is that following one market is kind of like living in a bubble where anything outside of that bubble can easily pop or destroy your trades. I mean, another example is if you're driving down a road with blinders on, you're not looking at left, you're not looking right, you're just looking straight. There's a lot of things going on in the markets, and all the markets that can impact how the currency market goes. And that includes things like how the stock market is doing, and we'll talk about this in much further detail, but how the stock market is doing, how the commodity markets are doing, things like that can really affect how your position will do. On a fundamental basis, I think it's clear that when the US economy sneezes, the rest of the world catches a cold. And that's a really interesting comment, because during the coronavirus COVID-19 period, the US dollar for most of the period was or is the strongest currency. And yet the US has more coronavirus cases than any other part of the world. And the reason why the US dollar still performs well, despite the fact that, you know, the US economy is significantly hurt by coronavirus, COVID-19, is because of the fact that when the US economy sneezes, the rest of the world catches a cold. It's because if the US economy is suffering, it's very difficult for the other countries to be thriving. It is also very difficult for other countries to recover if the US economy has not. So that is one of the reasons why the US dollar's performance may be illogical at times, especially when the center of the pain may be in the US. And the same goes for China. When China sneezes, the rest of the world gets burned as well. And so it's two parts of the world that we're watching. It's very difficult for the world to get its momentum going if one of the two economic giants is struggling, because that is what's because they are what drives the world's economy. So it's extremely important to keep your eyes open to other countries and other markets. So with the top-down approach, what you want to look at, what I look at every day when I start my trading day, is I always look at where stocks are. I look at what stocks did overnight. For me, I trade the New York session primarily. So what Asian equities, what European equities did overnight. I look at where equity futures, US equity futures are at 6:30 in the morning, New York time. I look at what bonds are doing. I look at what commodities are doing, and I also look at generally what currencies are doing. And I kind of absorb all that information into my brain, and I use that information to help me guide my trades. So, intermarket analysis. What is it? Why is it important? How do you do it? Well, basically, it involves taking all that information, the performance of the other markets, and looking for trades that are consistent with the performance of the markets. And we'll kind of wrap that up and into a more cleaner thought in a minute. But you want a situation where there isn't market divergence. The best trades are the ones where, let's say, you're trying to sell a currency pair. When you're trying to sell a currency pair and you're looking for it to fall, let's say the US dollar against the Japanese yen, for example, you do want a situation where equities may be falling too. Equity futures are pointing to a lower open, and maybe treasury yields are down too. The whole thought process here is that the more things on your side, the better. So if I'm looking to go into a short dollar yen trade, which is basically a risk on, risk off trade, then I want to see equities be lower. I want to see treasury yields be lower. I want to see market sentiment on my side. And I skipped a slide because I wanted to go straight to the key words, but basically, happy trader equals a happy market. Happy markets equal a happy trader. So that's when, so if you are looking for trades, like if you're looking to buy dollar yen, for example, which is a risk on trade, you want to make sure the other markets are positive as well, because that's what will support your trade. So risk on, risk off is an extremely important part of trading. And so basically understanding risk on, risk off is extraordinarily important. And so let's kind of dissect this a little bit, because I think it's really important for all of you to understand what this means. So within the world of risk on, risk off, there are two sets of currencies: high beta currencies and safe haven currencies. So what is a high beta currency? By definition, beta means the volatility of an asset compared to an index. So is it more volatile? Is it less volatile? And when you have high beta, it means it's more volatile. So a high beta currency is a more volatile currency. So typically, when markets are rallying, high beta currencies perform better. So if you wake up one day and you see that Dow futures are up 300, 400, 500, sometimes 600 points, then you probably want to look to buy high beta currencies. If you wake up and you see Dow futures, or if you're just trading and you know that you're going into the New York Open and you see that Dow futures are down, 200, 300, 400, 500 or more points, then perhaps you want to look to sell high beta currencies, because those currencies, because selling high beta currencies will end up being a much smarter trade. And I do this every single day. When I tune in at the start of the New York session around 6ish New York time, I look at stock futures, and that will determine to me whether I want to go long high beta currencies or short high beta currencies. The other set of currencies are safe haven currencies. Safe haven, just to explain this definition, is basically a place to escape unpleasant, dangerous things. So a safe haven currency are currencies that investors park their money in during uncertain and dangerous times. So when markets are rallying, safe haven currencies tend to weaken. When markets are falling, safe haven currencies tend to strengthen. So that's, I think, is really, really important to keep in mind, because that is something I think is kind of imperative, because if we do have a situation where equities are rallying, then you want to go long a safe haven currency, long a high beta currency, and short a safe haven currency. If the markets are crashing because investors are panicking, you want to go short a high beta currency and go long a safe haven currency. So what are these currencies? High beta currencies are currencies like Euro, Pound, Aussie, Kiwi, CAD. Safe haven currencies are the US dollar, Japanese yen, and Swiss franc. So basically what you want to do is you want to pair strong with weak, or pair weak with strong. And that's the first way to start thinking about your trades. And going back to the slide I skipped, typically if you want to gauge whether the market is risk on, risk off, there's these are some of the things that you look at. So basically, when the markets are risk on, you want to see the VIX kind of low, stocks are rallying, commodities are rallying, bond prices are lower, bond yields are higher, and you're seeing kind of a broad-based rally in currencies. That's the definition of a risk-on market. A risk-off market, on the other hand, is the complete opposite, where you want to basically see the VIX rising. The VIX is the measure of the volatility in the equity markets. And with any charting package, you can just type in VIX, or you can just Google VIX and you can see what a chart and see whether it's been going up or down. It's probably the least important of these things, because this is also the hardest to find, but it's still a valuable measure. So you want to see volatility rising, and that is usually caused by stocks falling. And typically in a risk-off environment, commodities are lower, bond prices are higher, and bond yields are lower. And then you typically see some sort of broad-based sell-off in the Forex market. And that is the definition of a risk-off market. So, as I was saying, just to repeat, because it's so important, the risk on currencies are Euro, Pound, Australian dollar, New Zealand dollar, Canadian dollar. When markets are rallying, when stocks are rising, these currencies tend to perform best. And usually it's unless there's something very specific going on in Australia, for example, if stocks are up 300 points, Aussie yen will probably be up as well. Of course, sometimes there's specific things that happen to a specific country, but that's basically, the way you should be thinking and the trades you should be thinking. So if stocks are down 3, 4, and sometimes, 1,000 points, then you could probably assume that, Aussie Swiss is trading lower, or Kiwi Swiss is trading lower. And so the point I want to make is you don't want to fight the tape. If stocks are down 300, 400, 500 points, don't try to go long Aussie yen unless you have a reason to believe that stocks are going to be turning higher. Because in that situation, chances are you're probably going to see that trade suffer more than, rather work out for you. You want market sentiment on your side. So if stocks are crashing, don't try to go long Aussie yen. Maybe it might be better to look for trades to sell Aussie yen than to go long Aussie yen. We're talking so much about this because risk on, risk off is so important. And to understand Forex fundamentals, the most important thing is to make sure that you have market sentiment, risk on, risk off on your side. Don't want to be fighting the tape. You don't want to be picking the wrong currency pair against a certain broader intermarket backdrop. And I hope that I've given you enough examples to understand that. So what determines risk on, risk off? Basically, risk on, risk off is determined by the 3 M's: macro, micro, and monetary policy. So we talked about macro already. We talked about the big stories. We talked about market sentiment. We talked about risk on, risk off. So let's go into monetary policy. When it comes to monetary policy, it's extremely important to know the players, know the mandates, and prepare properly. If there is only one thing that you follow in terms of fundamentals, or if there's only one thing you have the capacity to follow in terms of fundamentals, it should really be where monetary policy, and more specifically, where interest rates are headed. Because where interest rates are headed plays an extremely, extremely important role in where currencies are headed. And so when currencies are headed, sorry, I'm trying to go next to my next slide. Currencies are headed is often determined by where interest rates are headed. So the reason why this is so important is because of rollover. Whenever you buy or sell a currency pair, there's always rollover. So it's an interest rate spread that you pay overnight. Either you pay it or you receive it. These days, it's inconsequential. When you're in a zero interest rate world, interest rates are inconsequential. But I think this is really important to realize because the largest subset of money in the Forex market is basically money that moves from one part of the world to another in seek of the highest yield. Because when you go on an institutional investment basis, institutions are able to move money from the US to the UK to Australia to New Zealand to Canada very easily. It's not like us where we have to pay, the bank conversion rates and things like that and the commissions on top of it. They're moving it pretty much at raw rates. And they're moving their money around in search of the highest yield. And so this is kind of what, kind of created the carry trade. And rollover as a result is very, very important because money, big money, is always in search of not only the highest yield, but where interest rates could potentially continue to go up, or on the flip side, will not go down. And so that is why monetary policy is so important, because where interest rates are headed, basically determines where a currency is headed. Of course, it is much more complicated than that in the sense that the decision of where interest rates are headed really is determined by where an economy is headed. So you really got to think about where the economy is going in order to really think about where interest rates are going. And to do that, it's important to know the players, know their mandates, and prepare properly. So this is Jerome Powell, head of the U.S. Federal Reserve. And, he's been fighting, he's new compared to, I guess it's somewhat new to his term. He's been fighting political pressure from the White House and basically, trying to be as proactive as possible in supporting the economy. He basically, I wouldn't say he inherited because I guess you could say he inherited a slowing economy that could potentially turn into a contracting economy. And he's definitely presiding over the country's monetary policy during the COVID-19 coronavirus crisis. And so the Federal Reserve has basically slashed interest rates to zero and restarted quantitative easing in order to ease the pain in the economy. But what the most important thing to realize about the Federal Reserve is that they've made it very clear that the Federal Reserve can only impact lending and not necessarily spending. Because while they could impact spending through where interest rates are, after having brought interest rates all the way to zero, either people are going to spend or they're not going to spend. There's not really more that they could do on that front. All they can do is provide additional lending. So the Federal Reserve under Powell feels like in many ways they have their hands tied. And that's important to realize. Now, when it comes to raising interest rates, the Federal Reserve could end up being one of the first to raise interest rates. And usually, the Federal Reserve likes to telegraph changes. It's not as if they're going to just catch the market by surprise. They usually like to telegraph the changes, talk about how certain things may need to happen, and kind of set the market expectations for a certain move. So if the language from the central bank is going in one direction, and they're saying to you that they are thinking about normalizing monetary policy, and you don't think that that's necessary, I think it's really important to heed their word, because there's not a significant amount of division within the Federal Reserve. Their messaging, is very clear. I mean, of course, there's Federal Reserve presidents that have division, but when you hear all of the Federal Reserve presidents start to say something or think something or suggest that they're going less pessimistic or more optimistic, then policy is probably going to move in that direction. This is Christine Lagarde. She inherited her post after ECB President Draghi left office. Still relatively new. She is much more politically savvy than Mario Draghi, and in the past, she and the belief is that she may do a much better job of getting European governments to pony up money, because the ECB, she's inherited an economy that's slowing with the risk of recession in parts of the country, and the ECB has long resisted easing monetary policy more than they need. And the reason for that is because they really think that in order for the economies to turn around, for growth to settle, they basically need a situation where fiscal policy also steps up to the plate. So maybe she'll do a much better job of forcing the government's hands. And part of the way to do that is by not doing as much with monetary policy. And that's why the ECB has done a lot less than some of the other central banks. And so while many countries in Europe were hit very hard by COVID-19 and coronavirus, the fact that the ECB is doing a little less could lead to more aggressive short squeezes in the currency. In 2020, this man, Andrew Bailey, inherited the post of the Bank of England governor from Mark Carney. And we have no idea, exactly how monetary policy will be under his leadership. He's a new central bank governor. He's obviously not new to the central bank. He's been to the central bank for a very, very long time. The Bank of England in the past has been a very dynamic central bank, meaning that in past years, they can flip from easing monetary policy to tighten monetary policy in a very short period of time. And that dynamic ability is part of the reason, part of the way they've successfully managed the economy. Now, the double toll of Brexit and coronavirus poses specific challenges for Andrew Bailey. So I think that the Bank of England will probably have to maintain a easier monetary policy for a longer period of time than many other central banks, because they have a greater challenge than other central banks, than other countries, because they are dealing with Brexit as well as the economic crisis created by coronavirus. So these are just some of the things to know about central bankers. You know, obviously as global growth and the risks to the global economy changes, their behaviors and their way that they navigate monetary policy could change as well in response to unprecedented crisis. But it's extremely important to follow these three people carefully, because their policies will drive, or could end up driving, policies around the world. And in many ways, even if you're trading euro, Aussie, pounds, CAD, it's really the more actively traded currencies, the euro, the US dollar, the sterling, that tends to have a stronger driver of the overall movement of that currency. The best of type of trades we have is when you have monetary policy divergence. It may be some time before monetary policy divergence returns, where one central bank is, let's say, not doing anything, keeping policy unchanged, like Japan or Switzerland, who haven't changed interest rates for a very, very long time. And then the other central bank, like let's say in the future, we get the Reserve Bank of Australia, the Reserve Bank of New Zealand starting to raise interest rates. When you have divergence in monetary policy, when countries are doing different things, that's when the biggest opportunities happen. That's when the biggest trends happen. That's when our most lucrative trades happen. And that's when we had the thriving environment of carry trades. For some of you who may have been in the market for a little while, you may have heard of carry trades. And even if you haven't, carry trades was a really great trading strategy in the early 2000s, and will probably return at some point. And it will return at some point because economies have cycles. And so carry trades basically involves borrowing or selling a financial instrument with a low interest rate, and then using it to buy another one with a higher interest rate. An example is, you know, if you had the New Zealand dollar and its interest rate was 1.75%, and you had Japan whose interest rate was 0.1%, a quote unquote carry trade would basically be going long the New Zealand dollar, short the Japanese yen. We talked about how money flows from one part of the world to another in seek of the highest yields. And a lot of times countries also, or companies also, sell low yielding currencies, pay that nominal 0.1% interest rate, and then use that money to buy, you know, to invest and buy other things. And that's part of the reason why for a very long period of time before the coronavirus, the euro was weakening, because, you know, Europe had negative interest rates. So banks, corporations, funds who could move money from one part of the world to another were kept on selling euros and basically paying nothing and using that money to invest in other things. So when the stock market crashed and those investors need to quote unquote bail out of their trades, the euro soared. And the euro soared even though, you know, Europe was the second center. After China, Europe was the second center for coronavirus COVID-19. There was, I mean, Italy and Spain flared up before the US flared up. And yet the euro was soaring during that time. The reason why it was soaring was not because people were investing in euros and they thought that Europe was going to do, you know, come out better in this. The reason why they were buying euros is because they were unwinding the carry trades. Basically, they had paid almost nothing to sell euros and borrow in that currency and invest in other things. And so when the stock markets crashed, they were closing up those investments, unwinding their short euro trades, which basically involved buying back euros and driving the euro sharply higher as a result. So this is a very, very important concept to understand, because it can even drive currency flows in a low yielding world. But in order for carry trades to truly return, there's three conditions that need to happen. We need to have low volatility. You need to have an environment where risk appetite is strong, and you need to be in an environment where some central banks are thinking about raising interest rates. And that's when the carry trades will return. And the last M is micro. Micro just pertains to day-to-day economic data. it's what drives, you know, shorter term movements in currencies. So macro determines the big story and big themes and the general trends for the currency. Micro is often determined, monetary policy is often determined by macro, but monetary policy is also very important. But micro is what could affect how a currency moves on a day-to-day basis. And micro data, the type of economic reports that are important are the labor market reports, ISM, PMIs, because the ISM and PMIs give us the most quote unquote up-to-date look at how an economy is doing, because they tend to be the first set of numbers that come out for the most recent month. Retail sales, because consumer spending is the backbone of every economy. So without consumer spending, you're not going to have growth. Without growth, you're not going to have changes in interest rates. You're not going to have everything else that you hope to get. And then GDP, which is a function of retail sales and trade. And then inflation. Inflation is probably the least market moving, unless we're in a world where inflation becomes a serious problem. But the other ones are really what moves currencies more. But when it comes to trading micro, you only really want to trade data that is in line with risk appetite. So for example, if markets are selling off and you get a weak number that is consistent with risk appetite, which is consistent with the sell-off in the markets, then that will be a better trade than if markets are selling off and you get a good number, because investors may then be questioning the validity of that good number. So the trades that tend to be most fruitful is when trades on data that tends to be most fruitful is when you get the data that is in line with risk appetite. So what is economics and why should you care? And the reason why economics is important and why you should care is because it really determines where currencies are headed. And you hopefully take all of what I talked about in mind, macro, monetary policy, and micro, and use that information to put yourselves into the shoes of the central bank and to realize that while technicals are interesting, fundamentals determine where currencies go. And it's extraordinarily important to pay attention to fundamentals. And the last thing I want to talk about in fundamentals is business cycles, because business cycles are important. It's what I mentioned earlier, which is that when a currency starts to move in a certain direction, when an economy starts to move in a certain direction, basically, economies get better, or worse. They don't oftentimes get better, worse. So once the Titanic turns and starts moving in one direction, unless there's some sort of, unexpected shock, it usually just goes in that direction for a while before it's pushed in another one again. So in an expansion environment, we basically see household demand rise, business increase production, workers work more, companies hire, which then ends up being good for stocks, for currencies, and risk appetite. But, economies move in cycles. There's expansion and then there's recession. And recession is defined by 2 quarters of negative growth. In order for a country to be declared officially in recession, you need to have 2 quarters of negative growth. And typically with recession, you have consumer and demand declining, businesses cutting production, workers working less, companies eventually firing, which is bad for stocks, currencies, and risk appetite. In 2020, the first half of 2020 is going to be all focused on that, with countries cutting back as a result. And how are recessions fought? Because recessions is front and center of everyone's mind in early 2020, is that in 2020 recessions are fought basically through fiscal and monetary policy. Fiscal policy is basically in the form of tax cuts, increased spending, and unemployment insurance. These are the things that governments can do on a fiscal basis to fight recessions, or at least to ease the pain of recessions. With monetary policy for the Federal Reserve and for other central banks in similar ways, it's things like reducing the reserve requirement ratio, cutting the Fed funds rate, cutting the discount rate, buying government bonds, which is basically quantitative easing. And one thing that that is usually kind of the last measure is currency intervention. And for the Federal Reserve, it could be weakening the currency, because typically countries weaken the currency in order to boost growth, in order to make their goods more attractive. And that's what are some of the actions that people watch for when we have countries moving into recession. And I talked a lot about how, when I start my day, I look at how futures are doing, how stock futures are doing, how that determines risk appetite. The other thing that I look at, particularly when I'm trading the majors, which involve the US dollar, I always look at where stock futures are doing. I always look at what bond yields are doing. If bond yields are down a lot, 3, 4, 5%, if treasury yields down 3, 4, 5%, I am not going to be looking to buy US dollars that day. If treasury yields are up 3, 4, 5%, I'm going to be looking to buy treasury yields. I'm going to be looking to buy US dollars. I'm only going to be looking to buy US dollars in a market where we have treasury yields being up, and I'm only going to be looking to sell US dollars on a day if treasury yields are down. Because, if they're flat, then no big deal. That's not even an input to my decision. But if we do have, treasury yields, 10-year treasury yields up 3, 4, or 5%, that's going to play a very big role in how, what type of trades I take. And so that's something that I recommend you look at too, which is that if you can see, and you can use, even if you go to CNBC.com, Bloomberg.com, they'll tell you what the treasury yield is for that day and what the change is. If you use TradingView, which is a free charting package, you can type in your watch list. You can just add 10-year treasury yields to your watch list.
Okay, I'm just going to chime in here. I'm going to show you how to find those treasury yields, so don't worry. It's coming. So
there will be a chapter in this course that will show you how to do how to use TradingView to set up your watch list to look for yourself. But yes, so you want a situation where if you're trading the US dollar, and most of you will be trading the US dollar, the majors, you want the yields on your side. You don't want to fight the tape. We talked about how you don't want to fight the tape with risk appetite, high beta, safe haven currencies. You don't want to fight the tape with treasury yields either. Now, once again, if they're flat, no big deal. If they're like 0.5%, even 1% change, no big deal. But if anything more than that, you want to make sure that you have as many things in your favor as possible. And that's the most important thing about trading, period, which is that you want to have as many stars on your aligned on your side as possible. And that creates the best trades. So that's where we tie it all back to Forex, where the treasury yields have a really big influence on where, what type of trades you should take, which type of rate trades you should avoid, as does stocks and how stock futures are doing, because they will also tell you which currencies to get into, which ones to avoid, which can be very, very valuable. Other important things to know, two just important terms that are shared in the markets that people watch for, that people talk about. So I kind of want you to understand this vocabulary, which is fixings and option expirations. So basically, what fixings are, this is before I even show you that block text, I want to explain what fixings are. So corporations have to do hedging, and oftentimes they do hedging based upon what a printed exchange rate is for the day. As you may or may not know, currencies are a decentralized market, which means that there's no exchange. So there's no official quote unquote print, except at fixing times. At fixing times, some of the major news agencies like Reuters will have a official print for a certain time. So at that time is typically when we see a lot of the hedging activity occur, because that's the official, quasi-official print of what that currency is for the day. And for a lot of corporations, they're not very price sensitive. As long as they get their deal done, they're more time sensitive and they're price sensitive. And so as long as there's a print that they can, quote unquote, prove their transactions, they'll just go with it. So at fixing times, you tend to have a lot of unexplained movements because there should just be a lot of corporate or M&A activity happening at the fixing time, and then it'll stop. Option expirations can be thought of in the same way, where there's a lot of options in the markets. There's a lot of different types of options, like regular, plain vanilla calls and puts. There's also a lot of exotic options, like one touch, no touch. So the way I think about it is like, let's say you have a one touch option. If you have a one touch option, let's say you're a bank and you sold the customer euro dollar 110 one touch option. And the contract basically says that if euro dollar touches 110 before the expiration date, I'll pay you X million of dollars. If it doesn't touch 110 before the expiration date, I retain the premium that you paid me to buy that option. So imagine what's happening at that time. At the option or close to the option expiration time, the bank is doing everything in their power to prevent prevents the euro dollar from touching 110 because they don't want to pay you X million dollars. The option buyer, who is generally maybe a hedge fund, an institutional investor, basically someone else with a lot of money, will be doing everything in their power to get it to touch. And so there's a lot of tug of war. There's a lot of consolidation before the option expiration. And then when the option expires, everyone's like, it doesn't matter anymore. So then you see free for all movement and maybe a breakout after the option expiration. And these things can cause unexplained movements in currencies at specific times of day. So fixing. So most important fixing times are usually the morning in the Tokyo time, and then also the London fix, which is about 11 a.m. New York time. You tend to see unexplained movements leading to and abruptly after the fixing time. Same thing with option expirations. The most important option expiration times are 2 a.m. New York, 10 a.m. New York. I'm just referring to New York time because that's my time, but you can translate that to your local time. But once again, with option expirations, tend to be a lot of consolidation before the option expiration, and then probably breakouts after the option expiration happens. Okay, so that is all about the ABCs of Forex fundamentals. And I'm just going to take a 1 second break here so that when we cut this segment out, we can cut it appropriately. Okay, so the next lesson that I want to share with you is the best instruments to trade. The best instruments to trade in the Forex market, along with the best trading sessions to trade. Best instruments is much simpler in terms of options, and the best trading sessions is much more complicated. But in terms of the best instruments, so we talked about how there's the majors, and the majors basically are all of the currency pairs that involve the US dollar. These are the currency pairs that are the best to trade if you are looking for less spikes, tighter spreads, marginally lower volatility, but the most orderly movements. They also tend to be the best currencies to trade if you have a specific view on the US dollar, because these are the currencies that will be the most sensitive to the US dollar, because they obviously have the US dollar as part of the pair. So as a rule of thumb, dollar yen, dollar Swiss move on nothing but the market's appetite for US dollars and risk on, risk off. Euro is probably the most trending currency pair, and I wouldn't say like the easiest to trade, but it's definitely the most liquid. Sterling is not for the faint of heart. Sterling can have spikes all of the time for no reason and require wider stops and more risk tolerance. So if you are not someone who can tolerate a sudden 20 pip movement in one direction for no reason, then don't trade sterling. If you have a very, very strong US dollar view, meaning that, for example, you think that the US dollar will absolutely rise today because non-farm payrolls is so strong, then pound will move faster and further than pound dollar will move faster and further than probably euro dollar, Aussie dollar, or Kiwi dollar. Of course, that's not always the case, but pound is much more volatile and usually moves in one direction more pip-wise than some of the other majors. Dollar CAD tends to be much more restrained and obviously sensitive to oil. And Kiwi dollar and Aussie dollar can be really interesting. Major trades, particularly when you have a very strong risk on or risk off mode in the markets. The highest volatility pairs, however, are Euro Aussie, Euro CAD, Euro Kiwi, Pound Yen, Pound CAD, Pound Aussie, Pound Swiss. These are also the ones with some of the widest spreads. Pound anything, including the crosses, is not for the faint of heart. They will move aggressively. What may be an appropriate 30 pip stop for Euro Aussie is a very inappropriate stop for Pound Aussie. You need much wider stops. However, if you love trading the Googles of the markets and you love volatility, then the pound pairs will be very, very appropriate for you to trade. For me personally, I do not trade pound pairs at all because I usually like to have a 40, 50 pip stop of my trades, and that's a blink of an eye in the pound pairs. Euro Aussie, Euro CAD, Euro Kiwi are volatile, but those could be appropriate stops, and they tend to be very, very trending currencies, which I really, really love. And then the lower volatility crosses are things like Euro Swiss, Euro Pound, CAD Swiss, Aussie Swiss, Aussie CAD, things that are listed here. A pair like Euro Aussie and Aussie Swiss will be very, very correlated. So sometimes when I have high risk tolerance, when I'm willing to take on more risk and I have a very strong opinion on a trade, and I want it to move quickly and I want to get my profit target hit quickly, I will trade Euro Aussie. If I'm not so sure about the position, or if I'm in, profit preservation mode, meaning I made a lot of money, I don't want to give it back, I may trade Aussie Swiss because Aussie Swiss and Euro Aussie will move in the same direction, but the Euro version of that pair will move faster and more aggressively than the Swiss version of that pair. So that's something very important to keep in mind, because depending upon your view when you trade crosses and depending upon your risk appetite, you may choose to trade Euro Kiwi versus Kiwi Swiss, or CAD Euro CAD versus CAD Swiss. The yen pairs, Euro Yen, CAD Yen, Swiss Yen, Aussie Yen, Kiwi Yen, those are all really good candidates for risk on, risk off trades. Swiss Yen a little less volatile than Euro Yen. Euro Yen tends to move a little bit faster than Swiss Yen, just like the Euro crosses tend to be a little bit more. So best instruments to trade is what is the best instrument to trade is a trick question in a way. It should depend upon your risk appetite. It should depend upon your plan. You want to hit profit targets earlier with more risk, or you want to hit profit targets earlier because you have a stronger view, or you're not so certain and you want to take a trade in that direction with less risk and slower movements, and the Swiss pairs may be more appropriate. We will talk more about each of the major currencies in a little bit, so you can understand them in a little bit more detail, but this gives you a taste of of the way we look at currencies. My favorites are for lower volatility, majors and CAD crosses. Higher volatility, I love to trade Euro crosses, Swiss crosses, and Yen crosses. So, best trading sessions. What are the best trading sessions to trade? Well, the Forex market, we know the Forex market never sleeps. And one of the most unique aspects of the Forex market is that it runs 24 hours a day. And because it runs 24 hours a day, it is extremely important to understand the different personalities and characteristics of each of the different trading sessions, because by doing so, you can have different tactics for each of the trading sessions. So starting off, the trading day, for many people, we're going to start with the trading day kicking off with the London trading session. So what's unique about the London trading session is that because London is actually the most active Forex trading center, certainly over Asia, and certainly over the US as well, that's where you have the most movement and the most participation. So when the London session opens, what tends to happen is that European traders will look at their books and they will see what their positions are, and they'll look at what happened overnight. And you know, a lot of times when you have like a big story, let's say you have China cutting interest rates, and it leads to a big move in Asian currencies in Asia, then you may see a huge stall and very little continuation until London opens. So London opens, traders look at the news flow from overnight. They see that China or another central bank, let's say Reserve Bank of Australia, Reserve Bank of New Zealand, cuts interest rates. Then they respond. And that's when you have the second leg of movement in the currency. So in the London session, the beginning of the London session, first of all, you can get early breakouts. Another good example is that London traders are usually home and off the desk already when we have the New York close. And the last hour of trading in the New York sometimes can be a huge mover. Like there have been times in the past where moves have completely reversed in the last hour of trading in the stock market in the US at between 3 to 4 p.m. New York time. And so London traders may not get an opportunity to react to that until the next session, the next London trading session. So at the beginning of the London trading session, there has been a lot of breakouts and continuation from previous moves that you may have. And there could also be a lot of stop hunting. The Forex market is not as regulated because it's a global market. It's very difficult for have one regulator. It's not as regulated as the other markets. So what can happen is that at the start of the London trading session, dealers may look at their books and they say, you know, oh, these positions are large, they're close, let me just kind of fill them. And so you do unfortunately have some stop hunting. So the bottom line is at the beginning of the London trading session, there can be a lot of breakouts and fake outs because there's a lot of position adjustments that has nothing to do with what the real move of the day will be. It just has to do with, you know, responding to previous news or adjusting positions. US trading session, on the other hand, particularly when London and US overlap, is a very good period for continuation. So if you're a trend trader like me, typically the US trading session, particularly the first half of the US trading session, from 6:30 New York time to 10, 11, even 12 sometimes, 12 for 10:30 a.m. to like all the way to 12 p.m. you tend to have more continuation. And you tend to have very big moves, very big continuation moves. And that's when trend trading and momentum trades tend to be the most generous and most fruitful. And then comes the Asia trading session. The Asia trading session is generally quieter. There's more range trading. So for those of you that like to pick tops and bottoms, usually the Asia trading session is the best for that. For those of you that like to trade trends, momentum, and breakouts, the first part of the New York session is best for that, or the very early London session. But sometimes in Asia, when you can have unexpected announcements. Sometimes, whenever there's Bank of Japan intervention in past history, it's always been in the Asia trading session. Or, sometimes the president may make a big announcement in the Asia trading session. which is the afternoon time in the US. Or sometimes you may have China making an announcement in the Asia trading session. So while most of the time it's most conducive to range trading, buying top, selling bottoms, and more quiet trading, there are times when there could be very big breaks. So this is just kind of illustrates, the time of day and the type of movements you can see. We typically between 0 to 2 a.m. New York time, you tend to have, smaller amount of pips, but increasing volatility. At 2 a.m., you have a huge spike in movement, and then it kind of dies down until the New York Open, until about 6 a.m. Then you start to get your real big moves and breakouts during the New York Asia overlap. That tends to subside right around 11-ish New York time. And then it gets, the ranges tend to contract before the Asia Open, before it contracts again. So kind of shows you the average daily hourly moves of the euro dollar, which is very similar to what you see in the other currencies as well. Same thing with euro, big movements, with sterling, big movements at the beginning, and then spikes also during the New York session before dying down. This is an older table, but the facts still hold. And also true of dollar yen as well. You have your big burst of movement at the London Open, then consolidation, and then more burst of movements at the New York Open before there's a greater chance of reversals and consolidation afterwards. So how do we use this information to our knowledge? We use this information to our knowledge basically with the understanding that, after these spikes, but during these times of spikes, breakouts and following the trend is a better trade. And then when we have periods of consolidation, picking tops and bottoms are the best. The best way to look at this is to chop up the trading day. I chopped it up based upon the New York session, but you can take the times that I show and translate it to your local time. So there are 5 distinct New York trading sessions. There's the early New York, and each of them should be traded in a different way. There's the early New York trading session between 6:30 to 8 a.m. New York, even though I would say to 8:30. And then there's the second period, which is mostly focused on news, between 8:30 to 10 a.m. New York. Between that, you have the U.S. stock market open. So typically when at the New York stock market open, there's an opportunity. And then there's a unique trading behavior into the London close and then the New York close. So taking these one by one. At the early New York Open, which is actually my personal sweet spot for trading, and I think that most of you are probably awake during that time too. My personal sweet spot for trading is the early New York session, 6:30 a.m. to, it goes way past 8 a.m. It's usually 6:30 a.m. all the way to 9:30 a.m. That is when typically the major moves that we may have had in Europe carries over. The major moves that we have in Europe carries over to New York. Let's just say New York, not Asia. But it carries over to New York. And what ends up happening during this period is that typically when you start your trading day, you can look at how European markets have performed, Asian markets performed. So let's say European markets, European stocks were down sharply, and U.S. stocks were down. Sorry, European stocks were down sharply, and Asian stocks were down sharply. Then chances are the Dow futures will be down sharply. So when I turn on my trading screens at 6:30 a.m., I see that Dow futures are down sharply, and and then all the major currencies may have had a move in the European session. So typically from 6:30 to 9:30, oftentimes we have continuation. Whatever flows that happens, Europe carry over to North America. So it carries over to North America. I wonder if I can change this in my slide. Carries over, just so that we have it on record. Carries over to New York. So it carries over to New York. So this is when I get the best type of trend and continuation moves. So let's say we had a really, really big move in Dow futures, and Dow futures are down 300 points. Euro yen is down from the European session. So it's already down quite a bit going to New York Open. 80% of the time, Euro yen will continue to fall into the data release. And in the early New York Open, what you want to do is you want to look for continuation trades. And then once you get to 8:30, that's when you may want to close your positions, because if you may have a big release, U.S. non-farm payrolls, jobless claims, retail sales, GDP, all that stuff is released at 8:30 a.m. New York. So typically at this time is when you get the U.S. data releases, the big US data releases. So either you have a view of the data and you think it's going to support your trade, or you should be out of your positions if you've got a big release. Sometimes you don't have no release. Sometimes there's nothing consequential coming out. And at that point, you can keep your trades on until the New York stock market open at 9:30. But if there is a big release coming up that could threaten your position, and US data threatens pretty much all positions, all trades, even the crosses, most of the time, you want to be out if there's a big release. And there's only a handful, like basically retail sales, GDP, and jobless claims and non-farm payrolls are the only things that really matter. Jobless claim doesn't really matter, doesn't always matter, but in an environment where everyone's focused on jobs, then it does matter. So what's tradable? Non-farm payrolls. And then basically between 8:30 onwards, you want to focus on for 8:30 a.m. to 10 a.m. what you want to do is you want to look for news trading opportunities. And the news trading opportunities that are tradable are things like non-farm payrolls, rate decisions, retail sales. At that time, you also have Canadian retail sales, Canadian employment. Shortly thereafter, sometimes you'll have Bank of Canada rate decision, Canadian GDP, and Canadian inflation data. So between 8:30 and 10 is when you have your news trades. So typically with news, we like to trade news reactively. So what you can do, and we're going to be trading non-farm payrolls with you. We're going to be trading non-farm payrolls reactively in general, because non-farm payrolls is a very, very volatile release. But basically, with all of these things, you want to trade them predominantly reactively. So you want to wait for the event to come out. You want to see how it comes out, and then oftentimes, ride the continuation move up until either the New York stock market open or the London close. What's not tradable? U.S. inflation data, housing reports. ISMs are not really that tradable, but sometimes it is. And everything else I think is less consequential. So the first thing is that early New York open, you want to trade the continuation from Europe. And then the second period of the New York trading session is to trade the news releases. And then the third period of the New York trading session is when you have the US stock market open. So with the US stock market open, the first thing to realize is that at the start of the New York trading session, right at 9:30, pretty much between 9:30 and I would say 9:40, 9:45, you get the flush, meaning that if Dow futures had been up 300 points and dollar yen was rallying, you get another additional push higher right at the New York open. So you might get another flush higher in dollar yen, giving you just the prime opportunity to get out on your continuation trades. On the flip side, if Dow futures have been down a lot and you're short Aussie yen, right at the New York open, 9:30 to 9:40, 9:45, may get a flush lower as people who have been as the average mom and pop trader who may not be able to trade pre-market, wait for the market close and then put on their either close their positions or put on new positions. Between 9:30 a.m. to 9:40 a.m. you may get an additional push lower in Aussie yen, and that's maybe the opportunity for you to get out of trade. That's when you want to ride the equity market correlations. And it's a very, very brief period, because right afterwards at 9:45, you tend to have the reversals, meaning that, and you may have seen this in the stock market where, at the start of New York session, it opens, let's say Dow futures are pointing to, a 300-400 point open. It opens, it flushes lower almost instantaneously to a new low before kind of reversing. And that usually happens right around the 9:45 mark. So it's a very brief opportunity to get a little bit more of an oomph on your trade. And then the fourth period is when we have those option expirations and the pre-London closes. So pretty much when I'm trading momentum, I'm almost always out of my trades by 9:45, definitely by 10 o'clock. Because after 10 o'clock is when we get the reversals. Between 10 a.m. New York time to 12 noon New York time, which is the London close, that's when you typically have reversals. So whatever happened before, whereas in the beginning of the New York session, we have continuation. Typically, after 10 a.m., we tend to have reversals. And we tend to have no additional to continuation. So for those of you that would like to pick tops and bottoms, generally speaking, after 10 o'clock New York time, unless there's a 10 a.m. data like the ISMs or your University of Michigan Consumer Confidence Index or something else, shortly thereafter, the reversal moves will start to happen into London close at 12 p.m. New York time. And so if you like to pick tops and bottoms, that's the prime period to pick tops and bottoms, whereas you do not want to be picking tops and bottoms between 6:30 to 9:30 New York time, a.m. So the takeaway from that is that you want to maintain your existing momentum, trend, flow, whatever word you want to use, positions, up until 10 a.m., 9:30, 10 a.m. Then you want to focus on trading reversals from 10 a.m. to 12 p.m. And the last part of the trading day is the New York close. And the New York close is important for two reasons. Because it's important because, first of all, sometimes we have FOMC rate decisions at the end of the day, and that will have a direct impact on the FOMC rate decision. And then what you may have is oftentimes you may have big equity market swings in the last hour of trading. And so the last hour of trading is very, very significant because you can have complete market reversals, and that will lead, and that's basically the situation that will lead into an opportunity in Asia. Because if you had a huge market reversal, let's say stocks were up, hundreds of points and it ended up down in the last hour of trading, gave up all of its gains, which sometimes will happen, then you can bet on Asia opening lower. You can bet on continuation moves in dollar yen or whatever, Aussie yen. So the New York close is really, really significant, but only when, for Asia's trades, but only when you may have a major reversal in the last hour of trading. So how do you ride the European flow? There are 4 basic rules. I told you how my favorite trading session is the early New York session between 6:30 to about 9:30 a.m. New York time. And what I do is I ride the European flow. And the way I do that is I, first of all, combine the strongest versus the weakest currencies. So let's say on that given day, we may have a very, very strong move higher in the euro. And let's say euro, is up like 1% and the Australian dollar is up only 0.3%, then you're pairing a strong with a weak. And there's a very good chance that it can continue. There's a very good chance that you can have a that euro will continue to outperform between 6:30 and 9:30 New York time against the Australian dollar as the strong and weak divergences exacerbate at the start of the New York session. I always look at bond yields. I always look at stock futures for my dollar trades. So if I want to go long euro dollar, I want to go short Aussie dollar against the US dollar, how stock futures are doing, how bond yields are doing will play a very important role in whether I take those trades and what direction those trades are. Pair strong with weak, and I also check the calendar. For example, if I've got Canadian employment report coming out or Canadian retail sales, I may not trade the Canadian dollar that morning because the Canadian data is not released every day. It's every one, especially not important data. So when we have those days where we have very important releases, I may just pass in the trade on trading that currency pair. Same story. If we've got like U.S. retail sales or dollar yen or U.S. non-farm payrolls, I may pass on trading the dollar that day, and maybe I may pass trading everything, but maybe I'll trade like a cross that may not involve the US dollar. So that's basically the rules, the tactics and that you can use. And in terms of the tactics, just to repeat, between 6:30 to 7 a.m., that's when I initiate my trades. And at that time, I'm looking to pair strong with weak. I'm checking my bond yields. I'm checking the calendar. And I also look for moving average clearance, which we'll talk about in another chapter of our class. But I also look for moving average clearance. I look to close all my trades by 10:20 New York time, all my continuation trades by then. And then I trade reversals primarily between 10:20 to 12 noon New York time. Okay, so taking another mini break here so we can cut this video up. Now we're going to talk about some tips for trading all of the individual currencies, not just the US dollar, euro, British pound, and Japanese yen, but all of the major currencies that I have learned along the way. And I hope that you find these tips as valuable as I do, because it's really important to realize that every currency and every currency pair is unique. And the way you approach one currency, and to truly trade like a pro, involves understanding the unique characteristics of each of these currencies and using that to your advantage. So starting off with the US dollar. The first and most important tip for the US dollar is that the US dollar and the direction of the US dollar is determined by US yields and risk appetites. So when I start my day, the first thing I look at is what risk appetite is, which is determined by risk on, risk off, which is determined oftentimes by how the equity market or equity futures are doing. And I will also look at yields, and I will not sell the US dollar when yields are up, and I will not buy the US dollar when yields are down. And I will only take the trades, I will only take the long dollar trades when treasury yields are up and supporting my trade. I will only take short US dollar trades when treasury yields are down and supporting my trades. With that said though, if yields are flat and there's not much movement, like 1% or so, then then it doesn't matter. Then, you know, my opinion won't be based upon that. US data is also extraordinarily important to where the US dollar moves. Unlike some currencies where like the Japanese yen and the Swiss franc, where it doesn't matter whether Japanese data is strong or weak, or Swiss data is strong or weak. It doesn't matter at all. US data is extremely important and extremely big impact on how the US dollar trades and how what the market's appetite is. Another trading tip is that US dollar flows will often reverse when into the London market close. So that is an extremely important point that I hope I've mentioned quite often, which is that whatever's happening at the start of the New York session, when we go into the markets close to between 10 a.m. New York time, 12 p.m., whatever dollar flows often reverse into the London close. Dollar dictates where commodity prices are headed. It is very difficult for oil to be up when dollar is very strong. I mean, it does happen obviously when we have something specific going on that may be related to oil, but more often than not, it is very difficult for very difficult for commodity prices to move in one direction commodity prices to rise when the dollar is strong. They usually, a weak dollar leads to higher commodity prices, a stronger dollar leads to lower commodity prices. And so dollar dictates where commodity prices are headed. Euro, the first trading tip for the euro is that it's obviously the most liquid trading instrument in the world. And because it's the most liquid trading instrument in the world, the euro-US dollar currency pair has the tightest spreads. And that makes it, very attractive to trade for everyone. And it also, because it's such a liquid currency, it's a really, really popular currency to buy or sell when it has a huge interest rate advantage or disadvantage. So if we've got negative interest rates in the Eurozone, it becomes more attractive to sell the euro than other currencies because it's just more liquid and it's easier for people to get in and out. They don't have to pay the spread as much and things like that. But for us as traders, the most important trading tip for the euro is that it tends to trend, because it has so much liquidity, it tends to be one of the most trending currencies. So when a trend gets going, it likes to keep on going. And it trends more than it ranges in some ways. And momentum and trend trading opportunities is very, very good when it comes to the euro. The yield spread, the German US yield spread, is a strong determinant of where the euro is headed. Euro also has a very strong correlation with risk appetite, except when there's Eurozone credit issues, like when there's a sovereign debt issue specific to Europe, to the Eurozone, or there's a political crisis or a social crisis that may be like riots or something like that, that are specific to a country in the Eurozone, then it will basically trade on risk appetite. And that makes it, sometimes pretty easy to determine where it's going to go. One of the things I love about trading the euro is that it loves to run and break round numbers. So if it's going from 110.50 to 60, 70 to 80, then the chances are, if we're still in that momentum time zone between 6:30 a.m. to 10 a.m. New York time, then it's going to go to 111. It's going to run through the round number. It's going to break it too. It will go through 111 up to like maybe 110, and then it'll decide whether it wants to keep on going. But euro dollar, when it gets close enough to a round number, it loves to run and break the round number, whereas not all other currency pairs are true of. And so sometimes I'll trade that too. Sometimes I trade a run and a break of a round number in the euro because it has such a strong tendency to do that. And key levels are generally broken also after option expirations or the London close. So sometimes after the London close, with the euro, it still likes to make a run for the round number and still likes to break the round numbers. That's something also to be mindful of in the euro. Euro crosses. I love trading the euro crosses, and Euro Aussie, Euro Kiwi, Euro CAD, those are some of my Euro Yen, those are some of my favorite currencies to trade because they are so trending. So another way to look at this is that if you want to pick tops and bottoms, Euro Aussie, Euro Kiwi, Euro CAD are generally not great candidates for it. I mean, of course, there'll be times when that happens. So you want to make sure you have as much things on your side as possible. You want to make sure you have the technical setup, you have the risk appetite, you have the fundamentals, you have everything, in favor of that as possible. And then, you could get a good trade. You want to make sure your setup supports it. But in general, euro crosses tend to be very, very trending. Tend to trend more than range. And they tend to have a bit more wider spreads. Sterling, with sterling, it loves to follow interest rate differentials, but not the FTSE. Whereas euro likes to follow where DAX goes, sterling has very poor correlation with the FTSE, and but it does tend to follow interest rate differentials quite closely. It peaks after news releases. So oftentimes with UK data, a lot of people love to trade UK data because it can be very, very market moving. And that's true. But what can happen is that when we have UK data, let's say you have a really good retail sales numbers, it spikes higher, goes really high, and then you're thinking this is a great number, I'm going to join the trade, but then ends up peaking and it has no continuation. This is a natural characteristic of sterling and something that you want to be very careful with, because chasing the trade after data is usually the wrong way to go with sterling. Now, you may have continuation when North America, in the New York Open, because New York traders are looking at the UK data and they're responding to it. But after the initial burst in pound, then more often than not, when the data is released, you tend to have more consolidation, reversals than continuation. Whereas US data tends to have a lot of continuation. And there's also reversals likely after the London close. There's a little bit of a theme here. Pound is hyper volatile and has a tendency to reverse often. And the reversal times tend to be after data and also after the London close. But one good thing about pound is, like the euro, it loves, loves, loves to break round numbers. Gets anywhere near it and it loves to break it. And it just loves to kind of, really go in that direction. And that's also very tradable, because if it gets close to a round number, it's probably going to end up breaking it. And has very, very strong continuation moves. But even though it has very strong continuation moves, there could be a lot of hyper volatility within that strong continuation move, meaning that you may have 100 just a lot of roller coaster rides. It can go back and forth 20 pips in the blink of an eye and still end up going in the same direction. So just gotta be really, really careful with that. Pound crosses, pound pairs have the widest spreads of all the currency pairs that we trade. Needs the widest stops because of the volatility, because of its spreads, and is not for the faint of heart. You really need to, at the same time, it can hit profit target in a blink of an eye when you get it right. But if you don't, it can really get going in the opposite direction very quickly. And also with the pound crosses, if you're trading them, you've got to be patient, because if you've got a stop and it's a good enough stop, a wide enough stop, like I said, it can go back and forth quite a bit before it ends up in your direction. So you need to, either you have the conviction to stick with it or you don't trade it. In complete contrast though, the Japanese yen in many ways is a more mellow currency. Dollar yen in particular can sit dormant for days and then move wildly afterwards. So unlike euro and pound, dollar yen tends to be a much more consolidative currency pair. It tends to range trade more, and it can hover around certain key levels and not break it for a long time before finally breaking it and then really taking off. The yen itself has a very strong correlation with risk off trades. So yen is the quintessential safe haven currency because Japan has been one of the lowest yielding currencies for decades. So when markets are rallying, people love to sell the Japanese yen as a funding currency and use that to buy the Australian dollar, the US dollar, euro, sterling, New Zealand dollar, Canadian, everything in sight, and fund it with the low yielding Japanese yen. So dollar yen pairs have a very strong correlation with the stock market. So if stocks are crashing, there is no way that I am going to be selling the Japanese yen. I'm looking to buy the Japanese yen and sell Australian dollars, euros, US dollars, Swiss francs, whatever it is. I'll be looking to sell yen pairs. If stocks are soaring, I will not be looking for opportunities to buy the Japanese yen. I will be looking for opportunities to sell the Japanese yen against Aussie, against euros. So that means I'm looking to buy Aussie yen, buy euro yen, buy dollar yen when stocks are doing well. I'll be looking for opportunities to sell dollar yen, sell Aussie yen, sell euro yen when stocks are falling. Because it's a funding currency, it correlates strongly with risk off trades. is extremely vulnerable to trade war headlines because Japan and dollar yen is the most liquid Asian trading currency that is not controlled by the government, by a government like the Chinese yuan. And so when we have trade war headlines against that where China is involved, then dollar yen will be very sensitive to it and will have a very strong reaction. Dollar yen has a very strong correlation with the US 10-year Treasury yield. So dollar yen has a very strong correlation with that and the Nikkei. So I always look at that when I'm trading dollar yen. And then lastly, unlike euro and pound, it struggles to test and break round numbers. More often than not, dollar yen will fail before a round number or at a round number, then break it. So that is also a very tradable tip, which is that unlike the other currencies that love to run through it and tag the round number, dollar yen does not. Dollar yen will struggle through it and it may not get there. And that's something that I think is a very useful tip. I love to trade yen crosses, but when it comes to yen crosses, it's really about risk on, risk off. And so if you want to trade yen crosses as well, then basically what you want to do is you want to basically buy yen crosses when the markets are up and sell yen crosses when the markets are down. And that's is really a very valuable opportunity. And of course, all yen crosses are not made the same. Pound yen is much more volatile than euro yen. Swiss yen is less volatile than euro yen. Some of them are just have different volatility, but they're less volatile than the euro crosses and the pound crosses. The Canadian dollar. The most important trading tip for the Canadian dollar is its correlation with oil. It's very Canada is a huge oil producing country and has a very strong correlation with oil prices. And so if oil is going up, that tends to be good for the Canadian dollar. If it's going down, it tends to be bad for the Canadian dollar. So if I have a setup to buy dollar CAD, meaning to sell the Canadian dollar, buy the US dollar, and oil is up a lot that day, I will not trade it, take the signal. I want to make sure oil is on my side with every Canadian dollar trade I take. So I will only go long the Canadian dollar if oil is up. I only go short Canadian dollar if oil is down. Now, of course, oil is flat, then it doesn't have an impact on my decision. I get a quote unquote all clear. I'll take the trade anyway if other factors are supported. But I will not go counter to a big move in oil. So there have been times when oil is down 6-7%. I get a buy Canadian dollar signal. I will not take it. And that's how I feed that into my trading decision. And that's how I get as many stars aligned to my side as possible. And that's how I fuse fundamentals with technicals. Dollar CAD tracks the 2-year, dollar CAD likes to track the 2-year US Canadian yield spread. It has a very strong correlation with that. So, you can watch the yield spreads in TradingView. Dollar CAD doesn't always rise in good US data because sometimes people think that what's good for the US is good for Canada. So oftentimes, on the flip side, if we have a really weak US number, it could actually end up driving dollar CAD higher, even though it's a weak US number, because people think, oh no, conditions in the US are terrible. Its northern neighbor is going to be hit hard about that with this, and there's no way for the Canadian economy to thrive if the US economy isn't, and that is why dollar CAD doesn't always rise in good US data. So actually, when trading US or Canadian data, oftentimes CAD yen is better than dollar CAD to trade that, because dollar CAD can have some type of illogical reactions in some people's view, whereas CAD yen may have a much more logical reaction. The Canadian dollar is a risk on currency and it rallies when stocks rise. What I love about trading the Canadian dollar is that usually it does nothing in Europe. And so Aussie may be down a lot, Kiwi may be down a lot, CAD will be flat. at 6:30 New York time. But that is a prime time for when the New York market opens for the CAD to catch up. So CAD loves to catch up to what its commodity currency peers are doing at the start of the New York session. And I actually love to trade that. And I think it's a very high probability opportunity. Aside from playing catch up at market opens, the Canadian dollar can also have a delayed reaction on NFP day, because people usually, oftentimes, Canadian employment, US employment is released at the same time. And obviously everyone is focusing so much more on the US report than they are on the Canadian report. And so it can have a delayed reaction. And on NFP day, the best currency to trade, currency pair to trade, could oftentimes end up being CAD yen. So, you know, CAD yen really is a great currency pair to trade. CAD yen, CAD Swiss. I love to trade CAD yen, CAD Swiss. And yeah, it's tradable quite a bit during news releases. CAD crosses, I love to trade CAD crosses just as a rule of thumb, using all the techniques that we talked about earlier, based upon how oil is moving, based upon how the Canadian dollar may do catch up at the New York Open to some of its commodity currency peers, and then also based upon news. Speaking of commodity currencies, the Australian dollar, I also love to trade the Australian dollar. Has a really strong correlation with commodity prices, but I think more importantly, it's a risk-on, risk-off currency, and it likes to perform. It's a high beta risk-on, risk-off currency too. When markets are rallying, it likes to rally. When markets are selling off, it likes to sell off, and it has a real inclination to do so. So whenever we have a strong market move, one of the first currencies I turn to is Aussie, and I will not go long Aussie if stocks are selling off against the yen, against the Swiss franc, maybe against euro, maybe against the euro or the Canadian dollar, because that takes the US dollar piece and takes risk appetite out of the puzzle, and it's more of a pure strong weak play. But for the other currencies like Aussie yen, Aussie dollar, Aussie Swiss, I will only buy those when stocks are up. I only sell those when stocks are down. And this is not talking about like a 20-30 point move in stock. It's talking about hundreds of points. Because when the markets are flat, then that should not have a real impact on your trade unless it's coming off of a big level. But if it's up a lot or down a lot, you have to definitely take that into consideration in your trade. The Chinese yuan rate has a very important driver of the Aussie dollar weight, so keep that in mind, although it's less of a factor these days. Aussie likes to track the Australian US 2-year yield spread. I watch that very closely, but I think one of the most tradable tips I have for you is the Aussie data reversal. Oftentimes you will have a big number come out during the Asian Australian trading session, let's say Australian labor market numbers. They come out very strong. Aussie dollar pops. You say this is fabulous data. You jump in and go long, and then nothing happens. And in fact, not only does nothing happen, it may even reverse lower against you. And you're thinking, what is going on? I don't understand. But this is actually a very, very common characteristic of the Australian dollar, which is that the data moves in one direction and the currency reacts immediately, and then it does nothing, and it actually reverses, because the early Asia trading session, when these numbers come out, is when with the least amount of participation. So typically, aside from the knee-jerk low liquidity initial move, there's nothing else. And so you only get your second push in that direction when London opens. We have that London breakout trade where London traders wake up, they look at the Australian dollar data, see how wonderful it is, and then buy the currency pair for a second push. So there's a couple ways that you can use this information to your advantage. Number one, you can fade the data once it's been released. Obviously, you want to give it 5-10 minutes to stabilize and then fade it. You can wait to follow the previous direction at the London Open. Or you can just simply trade the data proactively beforehand, which is taking a view if you have a strong opinion about how Australia's has to shed jobs because the economy shut down. The real trade will be the proactive trade where you take it before the data release. So Asia session and all these in the Asia session with the Australian dollar, Australian data, New Zealand data, Japanese data, Chinese data can all have an impact on how Aussie dollar trades. I love to trade Aussie crosses, particularly during the New York Open, because they tend to have very, very strong correlations. Aussie crosses, Kiwi crosses are some of my favorites to trade. Kiwi, the most important trading tip is that it tends to have a very strong correlation with Aussie, but it tends to have higher beta, meaning that it tends to move more than the New Zealand dollar. And so if the markets are soaring, unless there's a specific Aussie development, oftentimes Kiwi will have a bigger movement than Aussie. Now, of course, there could be days when we have specific Australian data or Kiwi data that could change that fact, but Kiwi tends to be a higher beta and be a bigger mover than Aussie. New Zealand has dairy auctions twice a month that can actually be quite impactful for the New Zealand dollar. You know, Kiwi, New Zealand is a big dairy producer, and so you know, what dairy prices are can have a big influence in the currency. It's a carry trade risk on currency. It's a higher beta currency. So like Aussie, if stocks are rallying, you'll want to look for opportunities to buy. If stocks are selling off, you'll want to look for opportunities to sell. So in terms of Kiwi dollar trading behavior, it's very trending. It has minimal retracements, does have a smaller daily range, but it can break out quite a bit. And consolidated breakouts are very, very important. Last, and then Kiwi crosses, I love to trade them, and they tend to be, you know, more market moving than Aussie crosses in general, I think. And the last currency is the Swiss franc. There's not much to say about the Swiss franc aside that from the fact that it's has generally higher margin. It's a funding currency, which means that if it's like the yen, markets are doing well, Swiss franc will be sold. If markets are doing poorly, the Swiss franc will be bought. It tends to have tighter trading ranges, like Euro Swiss is very tighter trading ranges. And the Swiss National Bank likes to intervene in its currency sometimes, stealth intervention, which means that they don't tell the markets they're doing it, but they're intervening in the currency. That, you know, can have some unexplained movements in the Swiss franc that you may not see in some of the other currencies. With that said, Swiss crosses are very different. Euro Swiss, pound Swiss, I don't think is very tradable because there's, you know, Swiss franc and euro are correlated. Pound Swiss is all based upon how pound is moving. Swiss yen, sometimes you can trade it on risk appetite, but it's a little less interesting, although it is also less volatile than some of the other pairs. And then, you know, but the other ones like Aussie Swiss, Kiwi Swiss, like where they're basically like the yen pair, I love to trade those, and those can create quite a bit of opportunity. So we talked a lot about crosses, and there's a lot of opportunities in crosses. And the reason why they can be so attractive is because the US dollar will oftentimes dictate where the major currency pairs go. So sometimes the best relative value trades are the ones where you take the US dollar out of the puzzle. You take the US dollar and the market's appetite or US dollars out of the equation. And that is what makes, you know, currency crosses tick. And usually when it comes to currency crosses, it's much more of the strong versus weak pairing. Instead of just, you know, what is the market feeling about the US dollar period and across the board. It's a pure strong versus weak. But, you know, currency crosses are all very different, and they all have very different pip values, whereas the majors all have, you know, except for dollar yen, pretty much have all the same pip value, and they can change with time. So I encourage you to go to this link, which shows you the updated pip value in various currencies, and you can see, for example, that Aussie Kiwi has a much lower pip value than CAD Swiss. So that's important to keep in mind, because a 10-point move in 10 pip move in CAD Swiss is worth a lot more than a 10 pip move in Aussie Kiwi. So knowing the value of your currency cross is also very important, because that can help you value where your stop is. And it really truly gives us the best pure non-dollar trade. So that is what we do in terms of looking of all the major currencies. I'm going to take a mini break so we can cut this off, and then we'll look at questions. So all right, so now let's go ahead and see if there's any questions before Boris takes over. So I had a question here about the Chinese yuan in terms of its contribution to overall currency volume. And because the Chinese yuan is a managed currency, there is obviously a lot of demand for the Chinese yuan, because a lot of businesses are transacting with China, but it is still less compared to some of the other currencies. All right, so is there any other questions about what we talked about? And I hope you guys learned something. We covered a lot of stuff. A lot of these tips come from years and years of experience, and while we may have ran through them quickly, hopefully you've got these videos, you can watch it again over and over again, so that you'll see with time how to utilize some of these tips into your actual day-to-day trading, because they are, they do work. These are the natural characteristics of these currencies, and you will see that as you trade more and more often in the markets.
There was huge amount of information that Kathy just unloaded on you, especially in that last piece about how to trade each individual currency. There's stuff there that I took down as notes for myself. So I really recommend, I know it's a tremendous amount of information, and it's very, very hard to process all at once, but I really recommend you guys, we're gonna cut this up nicely, and we're obviously gonna put the whole video out for you guys by tomorrow, but then we're gonna cut it up nicely so that you can digest these pieces of information in watchable morsels. And I really recommend you watch this last piece about each particular currency pair. What the most important thing that Kathy, I think, showed you is when she does not trade the currency. There are very critical checklists on the fundamental side that she looks at, and I think that's the reason why she's so successful, is because when those fundamentals check off, then the technical setups become very, very easy. When they don't, you're forcing trades. So I really recommend you guys look through that, because if you want to emulate her consistency, this is probably one of the most valuable pieces of information she had in this whole presentation.
So I think I have a few questions coming in. One of them is, you said the Forex market is decentralized, but can there be volume used for trading? The only volume's in the futures market, but it obviously doesn't encompass the entire market. And definitely, the volume provided by a broker is not valuable, because it's only that broker's volume. Now, many brokers offer sentiment indicators, which show, how much of their clients are long or short a currency. That could actually be valuable, because those sentiment indicators, basically what they suggest is to use those sentiment indicators as fade measures, meaning that if the market is extraordinarily bullish, then the chances of it continuing on is unlikely. If it's extraordinarily bearish, the chances of a continuing fall is unlikely. But it's just more of a man on the street sentiment index, and you can use that. I do like using that, but aside from that, there's no true volume. So here's the $1 million question, $100 million question. How do you identify strong versus weak? It's actually really simple. Especially at the start of the day, you just look at the percentage change. And when Boris sets you up on TradingView and helps you set up the Forex watch list on your TradingView platform, it's going to be there all the time. You can see starting your session, and you want like a significant change. If it's like one is up 0.3%, the other one is up 0.2%, it means nothing. But if one is up 1% and the other one's up 0.2%, then you can already see how the market's looking at it in terms of strong versus weak. Is there depth of market data available for Forex market and is it effective? No, there's not.
And it's
So,
not effective.
therefore-
It's not effective either.
But good questions.
Yeah. See if there's any more. Okay. We'll give you like another 20, 30 seconds. If you guys have any more questions, feel free to post them up. And otherwise, we're going to take a small break because we're running a little bit late. And then we're going to dive into the mechanics. A lot of the mechanical questions you guys are asking, I'm going to hopefully be able to answer for you in the second half of the presentation. Okay, I think there's no more questions. So I'm going to take the screen and just bear with me a second here, guys. I want to line everything up properly. View present. Okay, let me see if I can make sure that I got make present to me. Show my screen. Which screen are we showing here? Audience view. Okay, perfect. All right, you're seeing my screen. Very nice. So let me see if there's no more questions, right? I think we're good. We're gonna let Kathy go a little bit. She did a great job. Thank you very much, Kay. I'm gonna take over, and we're gonna change tactics quite a lot. I mean, Kathy has given you tremendous amount of fundamental information about the various currencies, the critical issues that drive the currency market. But I want to take you back and kind of ask the much more general questions, the much more basic questions that really, really are critical to understand as sort of the ABCs of trading. You know, because if you don't understand these basic fundamental questions, a lot of the more complex stuff really doesn't make a lot of sense. So let's give it a little pause, and I'm going to start my presentation in just 1 second. Hi, everybody. This is Boris Schlossberg with BK Forex, and we're now in the second half of our lesson 1 of the very comprehensive Ultimate Masterclass of Trading. And in the second half, we're going to go a little bit backwards, a little bit more basic, and ask ourselves 3 critical questions. As a retail trader, what can you trade? What kind of instruments can you trade? How can you trade it? And then most importantly, where can you trade it? Because you'd be surprised, the ability to express your opinion is actually quite varied. And I hope to introduce you to a lot of different ideas that you may not have been aware of. So let's start with the first question. What can you trade? There are basically 4 asset classes that are available to retail traders that they can trade with complete and relative ease. The first asset class is our favorite. That's where really we made all of our bones. That's really where we focus a lot of our attention, is currencies. It's the biggest market. It's really what everybody on the retail side started out as trading. And you know, it's certainly ripe for opportunity on a daily basis, on an intraday basis. There's plenty of interest to trade. But the currencies were sort of like, I think, the first the first asset class that was democratized for the retail trader. And when I'm talking about democratized, I'm not talking about investor. I'm talking about trader. Trading, very differently from investing, involves, first of all, typically larger amount of leverage, and secondly, you know, greater amount of risk. It means much more active participation in the marketplaces. So currencies were, of course, the first asset class, and they introduced the retail market to the wonders of trading on a day-to-day basis. But very soon after that, many of the brokers started to introduce indices. Now, indices I would define essentially as various stock indices. Let's just sort of stick to stocks. But it also can involve bonds. It can involve other commodity indices. But really, for the retail marketplace, I would say like 90% of all trading and all focus is done in stock indices. And we'll talk about, what kind of stock indices there are, where you can trade them, what you can do. Then the next asset class that definitely attracts a lot of attention is commodities. But within that, there's really only two commodities that garner a vast amount of attention. And I'll talk about what those are. And finally, now, this is really, I think, development that's happened probably over the last 5 years, and it's really starting to accelerate significantly as many brokers across the world are now offer the ability for you to trade stocks, but in a very, very specific way, in a way to trade stocks that is almost option-like. What I mean by that is that it requires very little capital to trade very, very big stocks on an intraday basis, and we'll talk about how we can do that as well. So really, those are the four primary things that retail traders have complete and total access to. Now, of course, when I speak to the world of retail traders, I have to carve out sort of an exception for U.S. traders. U.S. traders, for the most part, are prevented in some ways, and I'm going to talk to you a lot about how U.S. traders are now really being exposed to, before they weren't allowed to, from indices, commodities, and stocks. Basically, for the longest amount of time, the U.S. traders could only really trade currencies on a speculative basis. That's changing, and I'm going to talk to you about why that's so exciting for the U.S. traders. But for everybody else, and really the majority of the world, of course, most of our customers are non-U.S., all these four asset classes are really available to trade. Let's take a look at each asset class and understand it really, really thoroughly. So currencies. Currencies, of course, biggest market in the world, trades more than $5 trillion a day, trades 5.5 days a week. So it starts at 1700 hours. I'm going to use military time or 2400-hour time, just so that nobody's confused as to exactly what I mean. It starts at 1700 hours New York on Sunday afternoon or Sunday night. That's when the currency market essentially officially opens. It actually, on the institutional side, it trades a couple of hours earlier. For example, New Zealand opens up like around 1500 hours New York. But for retail traders, all retail platforms open up at 1700 hours New York. And they all go uninterrupted. This is one of the most interesting things. There's no other market that is uninterrupted. No other market that's uninterrupted. Currency is the only market that is uninterrupted continuously until 1700 hours Friday afternoon New York, which makes it a 5.5 day week, the longest week, completely uninterrupted all the way through. Now, what's interesting about currencies that I bet most of you will find very surprising is it's actually the least volatile market in the world. The reason why you're probably shocked by that is because it's also the most leveraged, which is what makes it so risky. But to give you an idea, an average stock can trade 10% off of an earnings release, right? Google can go up and down 10% on a good, bad earnings beat. Tesla can go up 20% in a day, depending on whether Elon Musk is smoking pot or not. Currencies almost never go more than 10% in a year. And that's because if you think about this, it's not the nature of the beast. A currency, and we're talking about here the major currencies. We're talking about the absolutely biggest currencies of the biggest economies of the world that essentially comprise, 80% of the global GDP. Those currencies simply couldn't possibly be that volatile because their economies would just be completely in shambles if the value of their goods appreciated and depreciated by 50% on a matter of a monthly basis or even a yearly basis. So the actual unleveraged movement, that is cash on cash, 100% cash down, 100% cash trade is tiny, tiny. What makes the market risky, what makes the market interesting, what makes the market rewarding, but also very, very dangerous, is it's incredibly leveraged, right? If you're an investor, for example, in the United States of America, and you want to have margin on your stock portfolio, it's only 2 to 1 margin. You have a $100,000 portfolio. The most you can margin your portfolio is 200,000. In FX, that's not even child's play. In FX, you can margin your portfolio 100 to 1. So 100,000 becomes 10 million. You can trade 10 million on a single click, and that is what's exciting, but also very, very dangerous. So you need to appreciate that it's a double-edged sword. Now, what's interesting about FX and what is really, really happening pretty much across all the advanced industrialized world is that everybody is synchronizing on much, much lower margin. These are the snapshots. These are just the latest snapshots, but they're pretty much kind of universal. You can see Hong Kong only trades 20 to 1. That means for every $10,000 that you have in your account, you cannot trade more than 200,000 total. No, it's not 200,000 total, 2 million total. I'm sorry. You cannot trade more than 2 million total. In Japan, it's about 25 to 1. In Singapore, it's about 20 to 1. In Eurozone, the latest regulations just came out last year. It's now 25 to 1. US, which ironically enough was sort of the strictest because we came down to 50 to 1, I think 3 or 4 years ago. We were, or maybe even 5 years ago, we really got clipped very, very early. We're actually now kind of aggressive. We're at 50 to 1 on our margin. And sort of the lone outlier is Australia, which doesn't quite, I would say the average is 100 to 1. Australia doesn't really have regulations, but the thing is, there is just massive amount of press now. There's massive amount of pressure for the Australian regulator. We'll talk about who the regulators are in just a second, to kind of curb it down to 50 to 1. And there's of course huge amount of controversy and a lot of begging from brokers. But here's the thing, you think that this may be restrictive, but it's actually what they found when they implemented all these low leverage jurisdictions, is that people traded longer, they traded better, and they traded more profitably. So you don't need to have huge leverage to have excellent potential for profit. What you need, obviously, is the ability to have good accuracy. And what very, very often happens is that very high leverage just doesn't give you the opportunity to stay in the market. You basically get blown out too fast to learn. So ironically enough, lower leverage provides better trading ability as you go forward. So these are the leverage by jurisdiction, and it's essentially, I think, if you use the idea of between 25 to 50 to 1 as kind of your average globally, that's really where you want to be. That is really going to be the leverage going forward. Now, the thing you need to understand is that, of course, the Forex market is completely distributed, right? It's a global market where everybody feeds their prices into sort of a several big data houses of prices, but it's regulated by a whole bunch of different people everywhere in the world. There is no centralized authority. So, for example, in the United States of America, the Forex market is actually regulated by the National Futures Association, the NFA. In UK, the regulator is called the Financial Conduct Authority, the FCA. In Hong Kong, the regulator is called Hong Kong Monetary Authority. In Japan, the regulator is called the Financial Services Agency. In Europe, it's the European Securities and Markets Authority. In Singapore, it's the Monetary Authority of Singapore. And in Australia, it's ASIC, Australian Securities and Investments Commission. What's interesting is that sort of, if you go back to this slide that I want to show you, is that what you see is that even though there's a huge amount of different regulators, they're all unifying on a single standard. And I think that's the most important thing you need to understand. Going forward, is going to be pretty much a global universal agreement amongst all these regulators as to how this market will be traded. So you really need to be appreciative of that and aware of it. And that's the crux of how currencies are traded. Now, stock indices, which is the second big retail product that brokers introduced, are actually kind of an interesting product because they are incredibly national. Stock indices are, of course, the indexes of the national stocks of the stock markets of the various nations. And what's fascinating is every nation has something called the home nation bias. What it means is basically that if you're Australian, you are probably 5 to 10 times more likely to trade the ASX 200 than you are the German DAX. If you're German, it's pretty much going to be the reverse. You're going to be maybe even 25 times, 50 times more likely to trade the DAX than you are to trade the ASX 200, right? I mean, if you're an American, you're probably going to trade the S&P 500 or the Dow Jones. So what's interesting is that I think retail traders do themselves a big disservice because they don't ask the question of what's the most interesting, the most profitable, the most valuable market to trade. They're basically always asking themselves, what's my market to trade? And they're trading their national market. Now, part of the reason is because it's very, very comfortable. Your national market is open during your national hours, so it's easy to trade, and therefore, you get involved. But the thing is, most of these stock indices overlap quite a lot. There's a huge amount of time when the DAX and the S&P trade together, and the FTSE and the SP trade together. There's certainly quite a lot of some time when the ASX and the DAX trade together. And more importantly is that trading in your non-business hours. So if you're Australian, trading at night, which gives you the chance to trade the U.S. markets, or if you're a German, trading in the late afternoon, the U.S. markets, or perhaps very, very early morning, the Asian markets, is actually a really interesting opportunity to trade a completely different market with some potentially interesting profit possibilities. But regardless, the thing you really need to understand is just how incredibly local here. So those markets become. And most, as I said, most traders have home country bias. Now, the only global equity markets, and I mean the word global in quotes, meaning that they're not really global, but the ones that sort of everybody in the world trades the most are the U.S. indices. The U.S. indices are the Dow Jones Industrial Average, the S&P 500, the NASDAQ 100. It's really sort of, I think, it's interesting. I find that most retail traders like to trade the Dow Jones, which on most retail platforms is called the U.S. 30. Whereas in the U.S., the big market is the S&P 500, and of course the institutions trade the S&P 500. Dow Jones is considered to be kind of a poor stepchild. They're very, very similar. The differences between the two is minuscule. It's actually ironic that the 30 stocks in the Dow Jones essentially offer 95% similarity to the 500 stocks in the S&P 500 in terms of their performance. It's kind of fascinating. So these are the various global indices that everybody loves to trade: the S&P 500, the Dow Jones, the Nikkei, the Topix, which is the Nikkei 225 is kind of like the U.S. Dow Jones or the U.S. S&P 500, sort of the big, most well-capitalized companies in Japan, and Topix is the broader market. The Hang Seng is the Hong Kong index. The DAX, of course, is the German index. DAX is only 30 companies too. It's really interesting. DAX is incredibly volatile, one of the most volatile indices in the world. The FTSE 100. Kathy was talking about the idea of like, hey, the pound does not correlate to the FTSE. If the FTSE is up, the pound is generally going to be down. If the pound is up, the FTSE. If the pound is down, the FTSE is going to be up. So the question is, why is that? Well, the interesting answer to that is that the FTSE 100, the UK index, is actually made up of all these big UK corporations that do almost no business in UK. They're all multinationals, like Dutch Shell, and Tesco, whatever is made up in the FTSE. And the thing is that a strong currency is bad for them. they want a weak currency because they source in pounds and they sell in other currencies, so their profits really go up when the pound is down. So that's why the FTSE rallies when the pound falls, the FTSE falls when the pound rallies. That's the relationship between the two when you're trading them. The NASDAQ, of course, the U.S. high-tech index is incredibly volatile, very interesting. I trade it almost every day. It's truly, we're going to talk a lot more about all these relationships in the later classes, but these are just sort of some of the most fascinating indices to trade. And the ASX 200, great index to trade, by the way, for global traders because it's early Asia, it's evening in the U.S. It's kind of like late afternoon in the west coast of the U.S. You're coming back from work. This is one of the most active indices around there. You can trade that with a Nikkei and everything else. It makes it quite interesting. Now, the third asset class that everybody trades is commodities, right? And honestly, the brokers offer you anything you want. You could literally trade corn, coffee, palladium, I don't even know, cattle. You could trade soybeans. The brokers will let you trade whatever you want in this market. But the thing is that retail traders basically trade three things if you count silver. But they basically trade oil, gold, and occasionally they trade silver. So it's basically oil and precious metals. Those are the three things that everybody loves to trade, and that's where the focus is. And I would guess 90% of the market in the retail business is right then and there. Now, soft commodities like corn and coffee, of course, can be traded, but as I said, nobody really trades it. You could trade copper, you could trade nickel, you could do all that stuff, but I would be shocked if it makes up more than 5% of the commodity trading volume of most traders. Now, the reason, of course, is oil is the ultimate global currency, global commodity, right? Everybody needs oil. Oil is the foundation of industrialization. It's the foundation of civilization. It's energy, which is really the critical thing. Of course, oil is very much in the news, given what we have going on. But oil is always in the news. Oil is just a commodity that always represents energy. Energy represents power. Power represents civilization. And depending on how the dynamics are of the global economy and the global oil market, it has a big impact on it. And gold is really sort of the anti-money, right? Gold is really the trade on the anti-currencies. When we trade all those currencies, gold is what I call the anti-trust currency. When the global investors lose faith in the management of the fiat currencies. Fiat currencies are currencies essentially backed by nothing more than just your word, right? If you think about it, the dollar is backed by the word of the Fed, the euro is backed by the word of the ECB, the yen is backed by the word of the JGB. There's nothing backing them except their reputation. So when the markets kind of get distrustful of global management, they all run to gold, and gold becomes the currency of choice. Now, the last interesting asset that has really grown in popularity and is becoming more and more available for retail traders to trade is stocks. And again, here brokers offer you up to like 5,000 different stocks. And again, really the only thing that people really care about and people really trade amongst the 1,000+ stocks from across the world. You could trade Shell, you could trade Tesco, you could trade Lloyd's of London, you could trade Barclays, you could trade 100 different, you could trade Daimler, Benz, you could trade BMW, you can trade a million different brand names, all of which we know very well. Nobody cares. Nobody cares because in the retail space, really, what people love to trade is the FANGs, or the top 50 names, of which I would say, again, there's only top 50 stocks anybody ever trades, and within those top 50 stocks, the 5 stocks that everybody loves to trade is Facebook, Alphabet, Amazon, Netflix, Google, Microsoft, and Tesla. Microsoft is kind of not part of the FANG, but it's definitely very much tradable. So like you got these 6 stocks that everybody trades, right? And there's a reason, because they move. They like moving every day 10, 20, 30, 50 points at a time, sometimes 100 points at a time. That's what creates the great trading opportunities for the retail trader. So that's the overview of how we have of all the menu that's available to us. We can trade currencies, trade stock indices, we can trade commodities, we can trade individual stocks. And that gives us a pretty broad opportunity to make trades every day. Now comes the question of how is it that you can actually trade these things? Like what happens in each individual market? And I want to explain to you exactly how each one of these particular ideas is offered to you, so you fully understand all the risks and all the opportunities embedded in the instruments that are offered to you on the retail trading platforms. Let me just kind of stop here for 1 second and see if anybody's got, so far I don't see any additional questions. I'm happy to answer any questions that you may have right now, but if there isn't, I'm going to keep on moving because I don't want to keep you guys here for too long, and I have quite a lot of information I want to share with you. Okay, so how can you trade it? What can you trade amongst all these big asset classes? Let's start with spot FX, right? Well, actually, sort of let me explain the 4 different ways. This is really the interesting thing. There are 4 different ways that we can trade these various assets. We can trade them through spot FX. We can trade them through CFDs, and don't worry if these names are unfamiliar to you or you don't know what they mean, because I'm going to explain to you exactly which each one of these things means. You can trade them through spread bets, and you can trade them through futures. So let's talk about spot FX first, right? Spot FX is, of course, the market that we all love to trade, the market we're all familiar with, and I want you to understand exactly how this market functions. Basically, spot FX is a one-party to one-party market. So I'm a trader, you're a trader, we're a trader. We're not trading with these guys, okay? Between us and all these big guys is our individual broker. And really, if you wanted to make this diagram incredibly more realistic, you would have a whole bunch of individual brokers, like there's a whole bunch of individual brokers, and each broker has its own little trader sets, its own customers, and you trade with that broker, right? You're not trading with a bigger, broader market. That broker basically makes prices. The broker gets prices from that bigger market. So the EBS and the Reuters platforms and all the interbanks, all the big banks like JP Morgan Chase, like Deutsche Bank, like Goldman Sachs, all of them feed prices into here. And then the online market maker takes prices from all these guys into a central feed. Each one of these guys, by the way, mechanically, what they're doing is they're all of these, the price are fed in here, then there's a single feed that feeds out here, and all these online brokers, plug into the feed. The reason why there's so little discrepancy, for example, you'll notice that one broker has euro at 110, 110.05, and the other one is 0.06. It's literally 1/10 of a pip difference. The reason is why is because these markets are incredibly efficient. Everybody knows where everybody else's prices are. They're instantaneously disseminated across the world in milliseconds. And I'm not even explaining to you the incredible intricacies between all these guys. There's a whole bunch of high frequency trading firms like Citadel and Virtu that are doing even a better job of making the prices tighter, and they're happy to take all your orders. Basically, the online broker is going to quote your prices, make trades with you, and then decide, oh, you know what, these guys we're overloaded on euros, too much on the euros, we're going to sell to the interbank market, we're going to sell some of our position. But most of the time, they're actually keeping the position right then and here. It doesn't even touch these guys. All these guys do is provide the prices. The money pretty much stays right here. It doesn't even go. Occasionally, when the money gets too heavy, it flows back out in order for them to offset the risk. So it's really important to understand that. And it's also very important to understand that there's really 2 very distinct trading models in spot FX. There is the dealing desk model and the no dealing desk model, FX. So the dealing desk model is exactly what I was showing you here. Traders trade with their broker. The broker keeps all the money. Winning trades, losing trades. The broker is your bookie. You literally have to use the same analogy. The broker is your bookie. They're happy to, take money. And their basic underlying business idea is, listen, there are going to be a few guys, and maybe there'll be 20% of the guys that are going to make money. 80% of the guys are going to lose money. We're going to keep all the money because the 80% of the losses are going to more than give us profit. Like, they're obviously, your losses become their profits, and those losses are going to more than offset whatever losses we have, that is winners, that the 20% of the traders have. Okay, they're just, they're a casino. They're like a bookie. They're just making markets. They're happy to do this. There's nothing wrong with that, because that's a standard over-the-counter problem. By the way, if you think that this model doesn't occur on the institutional side, you're absolutely wrong. There's a bank here. The bank has institutional customers, insurance companies, hedge funds, whatever. The bank is doing the same thing. They're like, oh, you want to buy from us? Fine, we'll sell it to you. 9 out of 10 times, they're gonna inventory this money. They're not going to push it back into the other banks unless they just get too heavy on the position. So there's nothing nefarious about this. But there's also another type of a broker in the retail space called the no dealing desk broker, or straight through processing. That's what it's called. Straight through processing is the official kind of term. And there what they do is they don't hold anything. Let's go back to this model over here. They don't hold anything in the inventory. You make a trade. They charge you a commission. They charge you a markup, and they pass that trade right on, right? And again, I'm being simplistic, because in reality, what they do is they don't quite do it that quickly. Typically, your trades are tiny. You're tiny. They're very, very small. So what they're going to do is they're going to wait until kind of like they get 1 million, 10 million, 20 million worth of trades on one side, and then pass it on to the bank. But regardless, they're not holding inventory. They're moving money back and forth, and they're just happy to make commissions. And that's the non dealing desks. But whichever one is better really depends on which broker you trade with. At this point, I would say 5 years ago was a huge difference. At this point, as I said, just like everybody is regulating to a single standard, execution-wise, I find it, having looked at a huge amount of different brokers, having traded with some brokers who I never even know existed, I find that execution is pretty much the same everywhere. There are variances. I'm going to talk a lot about how each broker has its own little quirks, but on a day-to-day, in and out basis, pretty much execution is everywhere, because the markets are so efficient this month, right? So the one thing you do need to watch out for is there are some brokers that will, this is what's called a normal spread. So in FX, you have to buy the offer, sell the bid, right? This is the bid is what you're willing to buy things at. The broker is willing to buy things at. The offer is what he's willing to sell it to you. There's always a difference. Usually it's relatively tight. So in this case, the euro dollar 2 pips, that's actually quite wide. In modern parlance, 1 pip is pretty much the standard spread in the euro dollar. But occasionally what will happen is there's some brokers that will kind of keep it 1 pip to 2 pips almost all the time. All the time, they're willing to even during high volatility, they're willing to honor a very, very tight market. Sometimes some brokers will say, oh, you know what, forget it. The volatility is way too big. I can't take any risk. So we're going to make the spread much wider. It's going to be 20 pips wide, right? And typically, by the way, you will see this, first of all, when do you see this the most? Sunday night, when there's no liquidity, when the markets are just opening up, always the spreads are going to be wider at that point. During the day, every day, it's 1700 hours New York, when the markets get very, very quiet. The spreads are between 1700 hours and 1800 hours New York, you're always going to have wider spreads. These are things you must be aware of. It's not uniform. It's not continuous. Things expand and contract based upon time of day and location, right? And this, by the way, is sort of how all the spreads across the world get made. You have a whole bunch of competitive people putting out spreads really to the 6th decimal point, not even the 5th, the 6th decimal point. This is way, way beyond pips. This is like, this is the 5th decimal point. So this example, euro is 132.12. It goes 132.13, and the markets, the banks are willing to make all these prices. It goes into what's called an aggregation engine. The highest bid and the lowest offer go to the top, and then if they say I'm good for $1 million, I'm good for $2 million, and that goes what's called top of the book, and that becomes the spread. And your broker is basically aggregating all that at the back end and showing you these prices. But as you can see, everything is very, very competitive. These guys are very happy to make 1/10 of a penny on $1 million 100 times a day. So they're very, very, the margins are very thin, but they're very happy to trade at those things. And that's how the market is done. Hopefully that's clear. Let me see if I have any questions. But that's the basic we had. What are the recommended STP brokers for the U.S. resident? The only STP broker, I believe, there's 3 U.S. brokers: Forex.com, Oanda, and IG Markets. Only Oanda provides what I would call the STP experience. That is they give you what's called I forget what they call it. They call it core spreads. It's usually we call it raw spreads, but they call it core spreads, where the spreads are very, very tight and they charge you a commission. You may be able to trade with Forex.com on a STP basis, but that's only on their institutional platform, where I think they're probably going to ask you to drop $100,000 into it. Like it's a huge buy-in. So if you're a regular retail client with, let's say, a $10,000 account, your one opportunity is Oanda. And I'll actually show you a little bit later in the lesson how you can do that. So the other thing you want to understand, of course, is convention, right? How is currencies quoted? Like a lot of people get a big confusion as to like what's the value of a pip. The basic idea is that you have what's called a base currency and a quote currency. And the value of the currency, really the value of the currency, what this little formula always expresses is how much is 1 unit of this worth in this. So in this particular example, it takes 140 pennies, US pennies, to buy the euro. Like the current price on the euro is around 110, right? It takes about 110 US pennies. So your dollar is always an expression of how many dollar pennies, right? Dollar plus dollar pennies, it takes me to buy 1 euro, right? Now, the problem with the effects that confuse a lot of people is that it's not always, the dollar is not always the quote currency. Sometimes the dollar is the base currency, like in the case of dollar yen. In the case of dollar yen, the question is how many yen does it take to buy $1? And that's literally the price. Like this is it. It takes 77 yen. Remember, the Japanese never, ever adjusted for inflation, right? The wonderful thing, like I love that whenever you read like Japanese stories, he bought $1 trillion house and it turns out to be $5.95. And I'm just kidding you, but like basically 77 yen is $1, right? And that's actually not true, because that's an old stale quote. The current prices are like we're like at 109, 110. So it takes about 110 yen to buy $1. But that's what it's basically telling you. It's telling you, it's going to take you how many yen to buy this $1, right? So where people get a little bit fluxed is it's really, really easy. When it's a dollar at the end, right? You made 10 pips on let's say you were trading 10,000 units. What's a pip worth on a 10,000 unit? It's worth $1. So you make 10 pips, you make $10. Whenever you have a dollar at the end, you trade Aussie dollar, pound dollar, euro dollar, Kiwi dollar, super easy. Boom, boom, boom. It's always 1 pip equals $1, right? That's how you do it. Or if it's a standard lot, if it's 100,000, it's 10. 1 pip equals $10, right? The complicated thing is like, well, how much is it worth it when I'm trading like the inverse, dollar CAD, dollar Swiss, dollar yen? how many, so when you're doing, let's say when you're doing dollar CAD, and right now dollar CAD is around 140, right? Just for argument's sake, I'm just rounding it out. So what that's telling you is it's taking you 140 Canadian pennies to buy $1. Now, one person who's very happy about that is me, because I have 2 children in Canada, and I love having, having cheap CAD right now, because it makes transferring money to them a lot easier on my bank account. But yeah, so that's what it is. So in order to kind of convert, and I'm happy to I'll send you this little slide, or you can just sort of freeze frame the slide. It's just basically very easy. What you do, this is the formula if you want to convert. You take the size of the pip, the exchange rate, times it by, divided by the exchange rate, and then times it by the base currency. So in this case, what we're going to take is 1 pip, right, divided by, in this case, the dollar. It takes 106 yen to buy $1, right? So 161 divided by 106. So 1 divided by 106. If it was Canadian dollars, it would be 1 divided by 140, 1.40, right? Times 10,000, which is the basic mini lot that you're using. What's that worth? That means 1 pip is worth 94 US cents. When it comes to the Canadian dollars at 140, let me just show you. So it's like 1 divided by 1.4. It's actually 71 cents, right? When you're trading dollar CAD, each pip is worth 71 cents. So that's how you figure it out. It's super easy, but it's not really that confusing. But it can be a little daunting if you don't understand it, right? So the next thing we want to look at is the market called contract for differences, the instrument called contract for differences, which encompasses essentially all markets. Now, I don't want to confuse you, but I will tell you, I'm kind of going to let the secret out ahead of time. A contract for difference, let's just first of all understand what contract for difference is. Contract for difference is basically, it's a financial instrument that allows you to benefit from the movement of the price in stocks, commodities, indices, but actually also currencies, right? A contract for difference is basically an imaginary thing. You do not own anything. It's a side bet. It's basically a bet that says, oh, let's pretend you own euros. Let's pretend you own pounds. Let's pretend you own the DAX. And when you buy and it goes up, great. You made money. I'm going to pay the difference between what you paid and what you exited, right? You never actually own the underlying asset. It's just a side bet on the movement of the asset, Now, here's the thing that you probably will be surprised to hear. In the retail market, currencies are essentially CFDs. And the reason why I kind of want you to understand that is because you will never own 1 million euros in cash. They'll never be delivered to your bank account. In the institutional market, like when they traded currencies, people actually said, yeah, I want it. Like if I'm an exporter and I need euros to actually pay this guy who I'm selling to, whatever. I'm ordering some equipment from Germany, and I need to have literally 12 million euros in my bank account 30 days forward. The banks literally will wire you the euros into your bank account, and then you use those euros to pay your bills. They're actually taking physical possession of the stuff, right? We're never taking physical possession of stuff. If you don't ever touch the physical asset, you are in fact trading CFDs. So Keith is asking me, IGFX claims to be CFDFX. Is that the same as spot FX, as I don't see any difference? Pretty much, yes. It's a distinction without a difference. There are some physical differences in CFDs that we're going to get to, but the philosophical concept, if you think about it, what is a CFD? Is essentially is a side bet on an asset. That's all it is, a side bet. It has a couple of other interesting rules we're going to get into, but it's a side bet. You never actually own the asset. It's the difference between, I guess, a retail trader and an investor is actually going to want to physically own the asset, right? But we never. All we do is we trade in an imaginary world, right? Every trade you make, you don't actually own euros, you don't actually own pounds, you don't actually own Aussies, you don't actually own the DAX. You just own the right to be long the DAX. You own the right to be long the euros or short the euros or whatever you want to be. Is that clear? It's just one step removed from the actual asset. So it's very, very important to understand it. So they work very simple. You know, the trader expects the price of the asset to rise and makes a trade with a broker, right? He says, hey, you know, I think euro is going up. I want to buy the euro. The broker says, great. I'm quoting euro at this price, sold to you. The trade will be made without any physical delivery of the underlying asset, and the trade will be closed when the trader decides to close it, right? So he decides to close it. He says, oh, okay, now the euro is up 20 bucks. Pay me out, right? Pay me out, just like a casino, just like a broker, just like a bookie. Pay me out, right? CFD is an agreement between two parties to exchange at the close of the contract the difference between the opening and the closing price of the contract, multiplied by the number of shares. And those shares can be anything. It could be the value of the DAX, it could be the value of the S&P, it could be the value of the euro, it could be the value of Tesla, it could be the value of Microsoft, it could be the value of corn, it could be the value of coffee. Is that clear to everybody? That's what a CFD is. It was actually invented by IG, and it was probably one of the greatest, speculative inventions ever. So what makes, CFDs so interesting? Well, you take the ability to not have to own anything, and you combine that cocktail with the ability to not have to put down all the money for it, just finance it maybe at 5%. And you got a really interesting and sometimes very, very dangerous combination, right? Because let's just take an example, something like Tesla. Tesla is $500 a share, right? $500 a share. I go into my TD Ameritrade platform, and I want to buy 100 shares, right? 100 shares. I got to drop $50,000 into that one single trade just to trade 100 shares of Tesla, right? Now in comes in a CFD broker and says, hey, Mr. Boris. Everybody always calls me Mr. Boris when it always cracks me up. They put my first name and Mr. into my first name. Hey, you don't need to drop $50,000. You can own that same 100 shares with just 5% down, right? Or you can, typically it's not that aggressive. It's usually like 1/5, right? So I got to drop 10,000. In this case, I only need to put down 10,000. Actually, in CFDs, I could probably put down even like 2,000 to control $50,000 worth of Tesla stock. That's considerably more attractive to a lot of people because it doesn't use a lot more capital, right? For the same bang for buck. And that's the thing that makes CFDs so interesting. Now, the thing is that even though this is an abstract product, right? It's you don't own anything, right? You still got to settle up. There's still other, when you're making a bet on this product, you're making a bet on the instrument. This instrument has costs and revenues and things that go on in the real world, and everybody has to account for it, right? So if the stock is a high dividend stock, and you're long it, the broker is going to credit you part of that dividend. If you're short it, they're going to deduct it, just like if you were to own the actual stock, because all of that is all part and parcel of the price of the stock. You know how stocks trade ex dividend? Like let's say it's a $100 stock, it has a $1 dividend. Well, it's going to open up at 99, right? Well, that's going to change the price. So the CFD is going to change the same way, right? So all of that stuff gets accounted for. So here's how margin works, sort of an explanation. You have 100,000 pounds. You open a 50,000 pound trade, and it just requires what's called a good faith deposit, right, of $10,000. So that means that you're controlling $100,000 worth of stock product or any kind of an instrument product with just $10,000, right? And sometimes, the broker is going to tell you, oh, if the price really falls against you, they're going to say, no, you got to add more money. Or if it goes up, in your favor, then that 10,000, becomes 15,000, and you make, very, very quick profit. So it's always dynamic, it's always adjustable, but it's always a fraction, sometimes a tiny fraction of the notional value of the product. And that's what makes CFDs, of course, so interesting. But, and here's the thing that you're asking me, like, how is spot FX different from CFDs? So here's a whole bunch of tiny but definitely significant differences. So spot FX generally traded two ways: spread, just pay the spread and you're done, or really tight spread and pay me commission. Well, CFDs, it's not as clean and clear, because first of all, currencies are a million, trillion, quadrillion times more liquid than stocks, right? I mean, Euro trades in 1 minute probably more than Tesla trades in a day. So the spreads are going to be wider in the CFDs. But on top of that, they're also going to typically charge you a commission, right? And then, and this is the other thing that they don't tell you, and this is my whole job to tell you, is you're financing. You're essentially financing your purchase, right? So if you're holding this thing for more than a day, you're going to get charged interest. Even if whether you're long or short, if you're going to be short, you're definitely going to get charged interest because you're going to charge margin interest. But even if you're long, you pay interest. So it's like buying a house. It ain't free. You're only putting down a tiny amount of money, but every day the broker takes a vig. So you got to overcome interest, you got to overcome spread, you got to overcome commission. And still it's worth it. Still it's worth it because these things can move so much, especially if you're on the right side of it, that everybody loves to trade them. So that's the essence of how CFDs are constructed. Okay, let me just see if there's any questions on this. No, we're good. Okay. So a cousin of the CFDs, and really not very, very different, but has some very different tax ramifications. And this is really primarily for UK and Irish traders. Spread betting is a huge business in United Kingdom because literally what it is tax arbitrage. I mean, the more I kind of learned about this, I was like, the more ashamed I was of actually thinking about this. I'm like, this is just BS. It's a CFD that you just renamed into a spread bet, and you're trading stocks for tax free. That's really what it is. But because it's a huge tax concession, people love this. Spread bets work. It's a distinction without a difference. Work very, very similar to CFDs, but what you do is, instead of saying, hey, I want to buy 10,000, I want to buy $100,000 worth of Tesla, right? What you say is, okay, Tesla is 501 bid, 502 offer. I want to buy Tesla, right? And the broker says, okay, how many dollars per point? And in this case, a point is like a penny, not a, so a point is basically the smallest increment that this instrument is going to move in. So if it's a currency, it'll be a pip. If it's a stock, it will be the penny in the U.S. stocks. If it's a UK stock, it'll be a pence. If it's an index, it will be 1 point of the index. And you say how much you want to bet per point. And let's say you say $2 a point, right? That's essentially like a better way of thinking about this is like if we go back to the currency example. So currency is a CFD. I buy 10,000 unit position in the euro dollar. My movement is $1 per pip, right? 10,000 units. That's $1 per pip. So if you say, I want to establish an opening position on euro at 110, the broker says, fine. How much per point? You say $5 per point. $5 per point is the same thing as $5 per pip. Is the same thing as $50 right? So to me, spread betting is kind of like a, I love it, but like it's just ripe with all sorts of very bad trading behavior if you don't understand what you're doing, because you're thinking, oh, I'm only going to bet $5 a point, without realizing that you're betting $50,000 position. If you're betting $10 a point, you're betting $100,000 position. That's essentially how you need to think about spread betting. So they just invert the whole idea and use, they make you trade, instead of asking you size, they ask you how much per point. You can trade oil per point, right? So you say, I'm going to trade oil $2 a point. Well, if a point is a penny, that's like, oil moved $5. That's 500 points at $2 a point. If you were correct, you made 1,000, but if you were incorrect, you lost 1,000 just on a single betting trade. You see what I'm saying to you? So very, very important to really understand what you're doing when you're making a spread bet. How much size you do, because it's very sexy, it's very appealing. Oh, I'm only trading $1 a point. You're trading 10,000 units, my friend. You got to be careful, okay? So very, very important. So there's just sort of a couple of very intrinsic mechanical differences between spread bets and CFDs that you should know about. First of all, of course, none of them have any capital gains. So like it's basically a tax arbitrage play. It's an incredible tax dodge. That's really why they exist. It's a tax dodge with leverage. I mean, how much greater can you get? It's like the ultimate product, right? So in spread betting, no commissions. There's no commission in Forex, but there's commission in spread betting. There's also spread betting. There's no commission too, because they take all of that in, right? So in CFDs, they charge you a commission. Spread betting, they're like, yeah, $2 a point, no problem. Here's your bid ask, you're done. They're all leveraged. They're all, the actual mechanics pay off the same way. If you're correct on your trade, you make money. If you're correct on your long and it goes up, you're right. If you're incorrect, you're going to lose money. Everything is based on the underlying product, on the underlying market. So there's no doubt as to whether you're right or wrong. The one other mechanical difference, this is very, very important, is that all spread bets have an expiry date. They expire. So it's not a perpetual thing. CFDs basically get rolled over perpetually. It's a perpetual future. It's a perpetual, perpetual contract. This, you got to make a bet, and if it's, if it's like one day, boom, you either win or lose. If you're in if at that point at the end of the day it expires and you have lost money, they're going to just deduct money from your account. If you made money, they're just going to drop money in your account. It's very similar, kind of like to an option expiry date. But it's very important to understand that spread bets have expiries. So you want to make sure that you're trading this properly. So that's like 80% of the world trades this all the time. Hundreds of millions of people all across the world trade every possible product under the sun in this manner, primarily in a CFD manner, and the Anglo-Saxons traded in a spread betting manner. Okay, is that clear? Does everybody have any questions on the mechanics of these instruments? Everybody good? Okay. So now let's take a look at the final product, the final way for us to trade all these products, and that's through futures. Now, futures exist all across the world. They exist in Japan, they exist in Hong Kong, they exist in Singapore, they exist in Germany, but for our intents and purposes, we're going to focus on the US. But everything I say about the US futures product is essentially the exact same thing. It applies everywhere else. I'm going to focus on the US because this is where the opportunity lies now. This is where the truly interesting advances for retail traders are happening. So I really want to share this with you and explain to you exactly what's going on. So what are futures? Futures are basically also contracts. But the difference in futures is twofold. Number one, they actually deliver stuff. right? So if you are, my friend, trading futures on COMEX, oh, excuse me, on NYMEX, not on COMEX, on NYMEX, and you decide, yeah, I'm going to be long West Texas Intermediate futures contract, and that futures contract expires, and you didn't close out that contract, and you're long, I don't know, 10,000 barrels of West Texas Intermediate, you're going to get a call from your broker saying, hey, my friend, where do you want us to park that 10,000 barrels of oil that you just bought in the physical market? Futures essentially morph into physical product, right? So that's really important to know. So you have to understand that almost nobody keeps you know, in the retail side or even on the institutional side keeps that contracts open. As a matter of fact, there's a very distinct ritual in the futures market. So what happens is futures markets trade on a quarterly basis, right? You have like some futures markets trade on like a monthly basis, but the big futures markets that just, especially the stock index futures markets, trade like on a cycle, and it's a quarterly cycle. It's a March, June, September, December cycle, right? And so what happens is 3 weeks before that cycle expires, so 3 weeks before March expires, almost everybody rolls over to the June contract, right? And the liquidity, basically the March contract has no liquidity, and all the money goes into the June contract. And you'll see that because like if you're trading the futures platforms, you'll see like, oh, what happened? How come there's only like one contract bid when there should be 100 contracts bid? Because everybody now has moved over. So you kind of train yourself to move over. And even if you don't train yourself, your broker is going to just say to you, hey, my friend, do you know that we're now trading the front month is June? What are you doing in March, right? Because nobody expects on the speculative side for you to, that you're going to own the physical. But trust me, people have made mistakes, and sometimes people actually physically want it, They want physical delivery, Like for example, if you're trading gold, there's people who now want physical delivery of gold. And one of the interesting things that's going on right now is that the gold market, the futures market is $50, $60, $70 above the physical market because people are just so crazy for the product, and they want delivery. They don't care if they have to pay $50 above spot price because they want the delivery of the product. So it happens, but for our intents and purposes, it doesn't happen. Furthermore, the very nice thing is that while this applies to corn and soybeans and cattle and all the and palladium and oil and everything else, when it comes to financial futures, the stock index futures, right? The worst that happens to you is you get money or you get money taken out. You don't wake up in the morning of the expiry day and say, oh, here's your whole 500 S&P stocks you just got dumped into your portfolio. No, what happens is it settles into what's called cash settlement. Cash settlement is to just take the difference between whatever was the open and the close, and they either deduct money or they drop money into your account, and that's how it's done. So if you're sticking to financial futures, and that's, by the way, and I'm actually, I am not sure whether the currency markets also obviously trade futures. I'm not sure, but I think currency markets also settle in cash. They used to actually settle in physical currency. They used to literally call you, hey, what do you want that 100,000 euros or €1 million deposited? But I think now they stopped doing that and they settle everything into cash. But I'm not quite sure on the future side. But I'm on the currency side. But on the stock index side, it's definitely stock indices. So there's all sorts of futures contracts, right? But the two distinct differences is financial futures, which is stock indices, currencies, interest rate products like bonds, and physicals, which is energies, metals, agriculturals, and softs, right? You can do index futures trading, you can do commodity futures trading, you can do stock futures trading, right? So those are the big things in the futures markets. But the thing that makes the futures markets, and this, by the way, is an example of an S&P June. This is June 2016. It's like a very old snapshot. But as you can see, every month on the calendar has a special letter. right? So now we're trading, sorry, let me come back on this. We're trading, oh, this is blocking me on the thing in a second. The letter is M, right? We're trading, oh, sorry, there it is. We're trading June. So our letter is M. When we're doing like the futures contracts, our call letter would be M. I'm going to show you this a little bit right now, but what I'm really, right now, obviously it's Saturday, so we can't show you. In the next lesson, when we start the next lesson, I'm actually going to show you live futures trading, and you'll be able to see exactly how they're quoted and how the contracts are traded in a live environment. So anyways, you know, those are the mechanics of how the futures trade. The most obvious, incredibly valuable aspect of futures is that it's a single market. There is never a argument about price. Everybody is the same in the futures market. If you are the first guy, it's first come at highest price. It's price then time. So if I'm highest bid earliest, let's say I'm willing to buy, S&P 500 is 2,500 right now, and I'm going to be bid 2450 2 hours ago. Like, you know, I'm going to be the first guy in queue, right? So if the S&P 500 comes into 2450, right, on the price, it doesn't matter that Goldman Sachs and Morgan Stanley and everybody else wants the same price. Little Boris sitting out there with this one bid is the first guy to get filled. That's, of course, a huge advantage of the futures market. There is never an argument about a stop. There's never an argument about a limit. There's never an argument about a price, because the price is the same for everybody, and everybody is tagged on price time, right? So you get to, if you're standing in queue, you get to do this. Additionally, obviously, you can make bid ask. You can be the market maker. You can buy at the bid, you can sell at the ask if you want. And that's a very actually important execution component of trading futures. You want to make as much these days with very volatile markets. It's much more important to be in the market than trying to get queued with trying to get good prices. But you can always get better prices. You can always get wholesale prices in the futures market, which you can't get in the CFDs and FX. The biggest problem for futures markets is that they got so popular and so huge in price that they just became way too expensive. Way too expensive. One single contract of the S&P 500 on the mini side, not even the big institutional contract, but the mini side, is 150,000 notional, right? It's a big lot. It's a lot to trade, you know. If you move 100 points and each point is worth $50, you have now dropped, or you've either won or lost $5,000. Now, the S&P 500 has been moving 100 points a day, so you could have a $5,000 up day, $5,000 down day. That's great if you have a $100,000 account, but most retail traders only have a $10,000 account, and you can't speculate in a market that can wipe you out in a day on the smallest size possible, right? So last year, the Chicago Mercantile Exchange created the Micro E-minis, which was literally the single most popular product they've ever created. It instantaneously traded 1 million contracts a day, continues to trade millions. I haven't even looked at, honestly, at the figures. I guarantee you it's probably 2 million at this point a day per contract. So it's certainly more than enough for what you need to do. But the beautiful thing is, the reason why it became so popular is it's 1/10 the size. So now the 1 point in the S&P is now worth 50. It's worth 5. So even on a just if you want to hold it on a full day basis and the S&P moves 100 points is a pretty big move in the S&P. It moves 100 points, you know, you're up or down $500. That's a much more palatable movement on a $10,000 account. And you can withstand that move, or you can, you know, appreciate that move to the upside. And you can, you know, you can trade it continuously. And that's a huge advantage. In my opinion, what they did is actually create an incredibly viable competitor to the Spot FX product. For the first time ever, we have a single exchange-based product that has a single price, that is universal the world over, that doesn't trade 24 hours a day, it trades 23 hours a day. So it has a very weird, quirky convention. At 1600 hours New York, it closes. No, sorry, at 15 minutes after 1600 hours, 1615, it closes for 15 minutes. Then it reopens 1630 to 1700. Then it closes for 1 hour, 1700 to 1800. And then it reopens again and trades in the overnight session. So you get, effectively, for all intents and purposes, it's like it's open 23 hours a day. The 1 hour it's closed, nobody really cares about, because it's the flip between Asia and New York. Markets are kind of dead, and it just gives you a chance to, you can trade this. You can trade this 9 o'clock in the morning Tokyo, or you can trade it at 9 o'clock in the morning New York, with the same access, the same speed, the same execution, and stuff like that. So super great products. I've really been focusing. I'm going to show you lots of interesting strategies on that in our later sessions. But these 4 products, the S&P, the mini S&P, the mini NASDAQ, the mini Russell, the Russell is the small cap companies, and the mini Dow, have really become the new darlings of the speculative world. And they're just, I can't say good enough things for them. You can see this is the clearing and the trading. The other thing that's very important is you're not trading against your broker when you're trading with the futures contract. You're trading against the exchange. You're trading against the world. It doesn't really matter. The prices are all the same, but the bottom line is, the one great advantage of this is you now have a tiny size, and you have zero doubts about your price. It's not dependent on whether your broker fulfills the price for you. It's whether the price actually trades through. It's all driven by exchanges. Furthermore, by the way, what's interesting is that you have to understand that every single CFD, we're gonna look at that in our advanced classes, but every single CFD price, every single CFD that you're trading is derived from this price. This is the price that creates the US 30 CFD. This is the price that creates the S&P 500 CFD. This is the price that creates the NASDAQ 100 CFD. If you've ever traded any of those CFDs, you are trading the price that is set by these futures, because that is the price globally that's set up. Okay, so that's kind of the future, and you can see sort of the capital efficiency of this stuff. You only got to put down, and this, by the way, is actually very conservative, because there are plenty of brokers that will do much less than that. So you only got to put down $173 on an intraday basis. So in futures, there's another quirky thing you need to understand. If you're trading intraday means open of New York to close of New York. Open of New York to close of New York, when the stock market is open. All you got to do is put down $173 to trade the S&P 500. All you got to do is put down $200 to trade NASDAQ, maybe $100 to trade Dow, so on and so forth, right? If you're trading outside of exchange hours, so if you're trading the overnight session, that's called overnight margin, and then you got to put up a lot more money, but it's still quite very little. It's just $693 per contract, right? And that's on some brokers. There are other brokers, like this broker, for example, that has ridiculously low. Like, you only got to put down $40, and you got to just put down $600 on the overnight margin. So you could really, you could, no joke, you could trade the S&P with $1,000. I mean, that's not advisable. My advice generally is you want to have at minimum 3, but generally 5 times the overnight maintenance margin in your account to have a reasonable amount of room. So you really want to trade between $3,000 to $5,000 in your account to be able to trade 1 or 2 units of these things, without getting blown out too quickly. But you see that, all the game has completely changed. So just to make you understand, in the olden days, before May of last year, you needed $6,000 to hold just one contract. You needed $400 just to trade it, intraday. You see the difference? It's completely different. It's completely different. Same contract, same price, same execution, but just completely a more reasonable capital constraints, and that's what makes this now so much more interesting as a product. You see the notionals. It's 150,000 notional now. It's only 15,000 notional. So that it's a huge. That's a massive difference for a retail trader. Okay. Let's take a break here. Okay. Let's see if there's any additional questions here that you guys have. No? Is everybody clear? So I want to review before we kind of move on to the next part of the presentation. We have currencies, we have indices, we have commodities, and we have stocks. We can trade all of these things through spot FX, through CFDs, through spread bets, and through futures. Futures is the most recent kind of the mini micro futures. Futures have always existed, but they've just been outside, I think, the scope or the capital ability of most retail traders. And now we have retail, truly a true retail product for futures. So for those that want to speculate on US stock indices, that provides a very interesting opportunity. And for the rest of the world, we can trade CFDs, anything we want on the structure. So that provides us with enormous amount of opportunities, and we'll talk about those opportunities in the next several lessons. But now, I want to just take you on a tour of various brokers across the world. It's a completely random tour. It's not like I'm certainly not advocating for any of these brokers, although our preferred brokers is Oanda and Pepperstone. But everybody's certainly free to trade. Yes, any questions you have, please type, and I'll be happy to answer the questions as I go along. But while you're typing your questions, I want to guide you through these various brokers. Now, I made these videos. It's very, very important. I kind of want you to understand this. I made these videos, and I specifically did not preview them up. I did not edit anything out in these videos. I wanted to show you the process with the good, the bad, and the ugly, because I hated it when people show me products and they go, oh, see how easy it is to open this and do this and do this, and then they basically cut out all the stuff that's difficult. They cut out all the stuff that that they did on the side. They didn't show you, and then when you actually try and do the product, you're like, oh, how come this isn't working the way the guy showed it to me, right? So I made specifically a true documentary of these brokerage accounts. So it's kind of my way of explaining why some of these videos are going to be a little clunky, because I want you to fully appreciate that nothing is simple, nothing is clear, nothing is obvious. Everybody has strengths, everybody has weaknesses, and the most important thing, the single most important thing before you ever trade with anybody is to open up a demo account with these guys and bang away at the demo, not because you really care about the demo, but because you need to be super familiar with all their strengths and all their weaknesses before you place a single trade. Otherwise, you do what I've done all my life, which is you practice on real money. You can either practice on demo money and learn, or you can be an idiot like I was and from the school of hard knocks and practice on real money, right? So I'm just giving you hopefully much better advice than I've taken myself. So let's take a look at a couple of these brokers that I just did a video on. I think let me just see, hang on a second, guys. So I'm going to Let me look at the platforms. Okay, let me just come out of this. I'm going to load up. I think I'm going to load up. I did. Well, okay. You know what? Let's start. Let's actually. No, you know what? I'll do FXCM first. I'll do an oldie but a goodie. So FXCM, of course, is. Oops. Hang on a second. Let me just stop this. So first of all, to preface this, I'm gonna comment over. These videos have no sound. And I'll be happy to upload those videos. You guys can watch them on and on and on. But these videos have no sound because I want specifically to comment over them as they go along. And what you see here is me logging into FXCM. The thing that's interesting about FXCM is these guys are like, hey, you don't even need to sign up for an account. Just press this button, and here's our free platform demo. You can just check it out and bang away at it, right? So it's exactly what I do. I just kind of check out and bang away at it. And they're basically using a HTML5 demo, and it says, you can see like, my it pops up a Chrome window. It takes a while because again, it's all in browser. This is their in browser platform. So you see, it takes a while, right? It's going to take a while for all the price feeds to connect. It's hanging in there. Let me just see, where's my video here? Yeah, it's just, this video keeps going. And finally it connects, and finally you get the price feeds, and finally, it starts looking like this. So this is what I call their little baby version of their trading platform. And it allows you to, it has lots of components. Like you can do, commentary, you can add currencies on the side, you can add index CFDs. They don't trade stocks, they only trade index CFDs. So FXCM, I heard that maybe soon they're going to be coming out with actual individual stocks, but right now, as far as what they trade is just index CFDs on the platform. And you can see that while it's nice that you don't have to download a software and it's all in browser, it's an awkward layout in my opinion. It has very little functionality aside from just point and clicking away. If I want to buy sell mindlessly, it doesn't give me a lot of really cool functionality that I want out of a trading platform. It is a platform for what I would call a platform for dummies, right? But it does give you, one thing that's very cool about FXCM, you'll notice over here, is they're the only broker I know of, and it's a, let me just actually pause this 1 second to show you. Sorry, I want to back this up just 1 second. So the only broker I know that does this very, very well, their functionality layout, and you'll see this as we go further, tells you the low, the high of the day. This is like such basic, and this always pisses me off to no end. That why does the broker not tell you this in their platform? Sometimes it's buried, sometimes it's in some other platforms, but like they give you the low, high of the day, and they actually tell you how much they're going to charge you in daily interest on the roll, positive or negative. If you're positive or negative, sometimes it's going to be negative both ways because of the financing costs, So I think this is a DAX. A DAX is going to cost you both ways, whether you're long or short. It's going to cost you. But like they're very, very transparent that way. That's a super nice part of their feature, and it's kind of easy to do. So I think what I do here. Oh, I was looking. I was trying to figure out how to detach stuff. So I detached their the trading station, and this basically I detached the DAX here, and you see it's trading in a shot. It has a chart. And I actually think, I'm not sure, but this looks to me like the Trading View chart. You'll see this again in another broker. A lot of brokers have, in their web-based platform, have basically integrated the Trading View chart, which is something that we're going to talk about. I'm actually, as we're moving around here, my thought is I'm not going to torture you with a Trading View review today, especially because the markets are closed. So it's much more efficient and much more effective if we save the Trading View walkthrough for lesson 2 when I see you guys on Wednesday, and we'll do a full discussion and show. But this chart platform that you see over here is very much looks like Trading View. Now the other thing that's a little bit annoying about FXCM is they limit your ability your ability to how many instruments you can view on your platform at one time. So there's called a subscription list. In other words, you have access to all the currency pairs, but you can only look at 20 things at a time. So you got to subscribe. I want to subscribe to a particular instrument, and then you got to desubscribe. In other words, you got to get rid of one in order to make room for that 20 list, the list of 20 that you can have on your platform. Okay, so that's depending on whether you like it or not. It's just the reality of their platform, right? And so you see this over here where, so I think I was trying to subscribe to something. I think I was just trying to subscribe to just show you how to get rid of something and subscribe to something. So I think I was trying to find a Dow. I was looking for US 30, and I think I subscribed to it. But in order to see the US 30, I'm trying to get it in. But in order to get it into this list, I got to get rid of something. So now I finally figure out what do I need to get rid of in order to bring in the 30. And then I look around and I see, and then I look around and I see what else can I subscribe to. So I just decided I'm going to subscribe to copper. So I got rid of a couple of things, and then I got rid of it. Now you can see I got copper over here, and I got the US 30 over here. But in order to be able to have that, I have to get rid of a couple of instruments. Very important to understand that that's just the quirk of how they behave, right? So the next thing is you can add charts, you can add price panels, you can do layout, you can do economic calendar. So so I added economic calendar. I was like, okay, let's see what happens here. I'm going to add economic calendar. So I got the economic calendar, and then and I'm like, where's this economic calendar, right? And you can see the constraint. You can see the awkwardness of a web-based platform where you're like, where the hell is all this stuff? I got to close stuff out. I got to find it. I can't quite find the widget that I want. So then I go, then I went to say, show me news. Okay, so I want to add news. So I added news, right? So now you see all of a sudden when I added news, everything kind of moved down, right? So now I don't see quotes. I just see news on the bottom here. I see the charts to the side. I got to move up and down within the browser. It's a, it's a platform for dummies, as I said. If you want to bang away at the euro and the pound without a lot of tool sets, this is a great way to do it. What is good about it is that certainly it's by far the easiest demo platform to start, because they don't even ask you for your name and password. It's just like, boom, here you go, bang away, my friend. And I highly recommend you kind of do that because it's so easy. And then here I go. This is where I was looking for my economic calendar. It's buried all the way down here. Can you imagine? I got to go look down here and come back up. And I got to go look at my charts. It's just everything, because everything has to be containerized within the browser. It's kind of an awkward situation. So I say, okay, screw this. Let's go look at what these guys have been doing for the last 20 years, which is their trading station, right? So actually, when we were, so just a little bit of background, Kathy and I started our career at FXCM. And of course, there's a whole bunch of Russian programmers who made the FXCM trading station. We used to call that the Stalinist trading station, because it literally was, you'll see it. It's not pretty to look at, but man, it just never quit. It is a rock. They literally haven't changed it in 20 years in terms of how the trading station looks. But let me show you. So you download the whole thing, and then so what am I doing over here in this part of the video? Oh yeah, so I downloaded. It's a typical Windows install. By the way, it's a Windows only product, so obviously you can't use it on a Mac. You let it install. And I'm actually going to I show this to you in a couple of instances where I want you to see how long it takes, the time, whether it's going to stall, all these things. I want you to get a full feel of the experience of these platforms. But see, it's just it's not quick. In the meantime, Sander is asking me, if you trade a futures contract, you can basically place a bid or ask for a certain price until a certain time. It's called you can do it in perpetuity. It's called good till cancel or day only. So you could actually have that bid forever if you want it to be, or ask forever, right? So yeah, the answer is yes. So okay, so we downloaded the futures platform, right? And finally now it's loading. Now you see it's, it is not the prettiest thing in the world, but man, is this thing solid? I mean, I really had pangs of wistfulness when I started banging away from it, because I used to just love this platform as a child in my younger days. So here you sign up for it. They actually give you a demo. You can load it up, and it's pretty much similar to what you see on the browser. But the thing is, it's modular. It's truly modular. You're not containerized by the browser, so that means all these elements are movable and therefore much more manageable. Plus, it has the chart element completely. The chart element is a completely different window. If you have a two-screen setup, like you see me bringing that up, it's because I have a two-screen setup in this particular case. So I'm bringing it from the bottom screen just to show you. So you can do all sorts of charts on this thing, and I'm bringing it back down to the screen. And now you have your instrument set over here. You have your news to the sideline. Now here's what's very, very cool about it. It's I want to bang away. Let me just see if I think I finally make a trade here just to show you. So I buy something. I buy the FTSE, right? I think I buy the FTSE, and you literally click on it like this. Now here's the other thing is, when you first click on it, it asks you, do you want to buy it, so on and so forth, right? And you do, you buy it, and it tells you the margin, it tells you the open, the close. It's very, very, very clear. It is literally the clearest platform in my mind as to what you did. But you can also, if you want to trade fast, you can go into options. You can go to trade settings. You can say, I want to do single click, one click, and then it'll say, and you say okay, and it'll obviously ask you for a disclaimer. And you say yes, I'm fully aware of all the risks I'm willing to do. But then watch this. You can literally do this like a single click trade. So I think what I do, I buy euro. I buy euro, single click. Now what's cool? You see that little close button? Let me just actually pause this. Okay. You see this little close button? Oh, sorry, it went away. So let me just go back. Where was this? Okay, so I say one click. Let me just pause this for a second. Yeah, my apologies for making you guys watch this again. But boom. So I want. Oh no, I gotta play it a little more. Okay, pause. So you see this close button? You see how easy it is? You literally click on that and boom, you're out of the trade. That's a very, very good functionality. And remember, this is a Windows, it's a Windows platform, so the connection is super fast, and it's just boom, boom, boom. There's zero lag here in terms of trading. So you hit close, boom, and you're out, and you're good to go. And you have charts. I think I'm okay, so one other thing I want to show you. This is another very cool thing, very unique to FXCM that I absolutely love it. Again, I don't understand. I just literally don't understand. I'm going to pause for a second. This is something that's a pet peeve of mine for the last 10 years. I don't understand why every other broker doesn't do this, but let me just show you what FXCM does. It's so cool. So you go over here, and you can trade off the chart. And by the way, you don't have to trade this. Anytime you pull up a chart, this will be visible on the chart, even if you don't trade off the chart. But I bought pound 45, 46, right? And here's what it does. Look what it does. It marks an arrow. It tells me, what I did, that I bought price, and it's red because I'm losing money, right? So, but it marks the price on the candle. That's such a simple thing, but it's so useful when you want to review visually. What did I do in this trade? How come I traded pound 10 times today? What the hell did I do? Do you think it's easy to reconstruct your path looking at a whole bunch of transaction data, or do you think it's easy to reconstruct your path looking at something visually? Obviously visually. Obviously this is a million times better. I don't understand why every broker in the world doesn't do this, but only FXCM does this, and it's a great feature. So you go like this, and then you press this forward, And now, now it's okay. I'm long this thing, and then I want to get out of it. I'm just showing you, getting out of the trade. I clicked it, and boom, you see it marked my trade. So it shows that I bought and sold on this particular candle like a moron, and I lost money, and so on and so forth. But imagine, if you had an actual, I bought over here, I sold over here, I bought over here. You can literally see all your footsteps. This is such a simple, easy thing. No other broker does this, and that's it's a big plus. At least no other broker that I know of. But like FXCM's trading platform for that is super valuable. So oh, sorry, I forgot. Let me stop over here. And you see how over here it tells you the actual amount of winning and losing. So it was 1.9 pips that I lost, right? So visually capping the results of your trade, such a great little feature. Every broker in the world should have it. These guys don't have it. So good stuff. That's the FXCM video. Okay. So now, sorry, let me get out of this. What am I doing? Stop. No, sorry. Oh gosh, I'm sorry, guys. Okay, here we go. I'm back to my slides. So that's FXCM. Oh, somebody tells me that Pro Real Time. I've never heard of these guys. So I'm sort of I'm sticking primarily so one of the most important things I sort of going to get to this at the end. But you notice that there's a commonality to all these brokers that I chose. Every one of these brokers is licensed by one of these big licensees. Whether it's ASIC or FCA or ESMA, some of them are licensed by multiple regulators. So I've never heard of, maybe Pro Real Time is actually licensed. I've just never heard of them. But and it's great that they do. That's great that they do. My point is that every broker should do this. So it's just a really great great little tool that I think everybody should have. And the thing is, some people do it, but they do it in such a crappy way. Like the thing FXCM does, it's so clean, clear, visible, beautiful. I think the only problem is they only keep it for like a day and a half. Like they don't keep the full historical history. Again, like great idea, but not fully well executed. Anyways, let's take a look at another broker. Let's take a look at Oanda. Okay, so completely different broker. Broker that I trade with myself. That I this is a demo account. But I obviously trade with the real account with FXCM. And I just want to show you. So one of the great things about Oanda, and this is truly, I would say, one of their best things, is you can do anything in this particular broker without ever having to talk to anybody. You can wire money in, deposit money, but more importantly, I'm going to show you, you can set up as many accounts as you want in whatever format you want, without ever talking to a human being. So, for example, at FXCM you can't do that. And a lot of other brokers, you have to call them, you have to beg them for it. They have to do this. It takes a while. A company like Pepperstone actually has this functionality, but nobody has the functionality to the level that Oanda does. So I want to show you the back office of Oanda and just show you how it's working. So what I'm doing right now is I have a $100,000 Australian fake account, and they have two types of. By the way, sorry, let me just stop this. They have two types of accounts. They have the MetaTrader account, which is what a lot of brokers have, and they have their own what they call FX trade accounts. And you can choose whether you want to have an additional MetaTrader account or an FX trade account. So in this case, I'm actually creating a fake MetaTrader account, right? And let's go on more with show you what we're doing here. Is moving? Okay. And so I'm creating the account, and you create the account, you create your own password. You can decide whether you want it to be raw spreads or commission. So if it's active, then it's raw spreads, and they just charge you commission and vary raw spreads, or you can make it all spread. And I just decided, to make it all spread. You can decide what currency you want the account to be in. You can decide what kind of leverage you want to be in. You see, everything is completely configurable without you talking to a human being. That's a huge plus, because you know how salespeople are. First of all, they're never available. They're always slow. You spend an hour waiting for somebody to just give you the permission to do something that you yourself can do. So the great thing about Oanda is they give you full flexibility to do whatever you want to do. So here I'm just showing you that when it's an MT4, it's going to generate an MT4 number, and then it's going to generate the server that it's going to be on. So this is where it gets interesting. And this is where I want to show you all the ugly stuff that nobody ever shows you, right? So you're going to go into MT4, and we'll talk, for those of you who don't know MT4, we'll discuss that a little bit later. But here I am, I'm logging into, I'm putting in my account number, and I'm looking for this server. Remember, the server says, if you remember from the video, trust me on this, the server says demo 4, right? Demo 4. And I'm looking, and I'm going, where do you have this demo 4? There's no demo 4 here. I can't find the server. I can't find the server. I can't log in. How can I, what's going on? I can't, and this is super common, right? Super common. So here's, you got to figure out what to do here. So I can't find the right server. So I'm like, okay, I'm just going to take the demo server. Maybe it'll work. I'm going to say the practice server, right? Will it work? No, it doesn't work, right? Nothing's logged. This is actually my real account, one of my real accounts. I'm trying to log into this fake account, into this demo account, and I can't do it. So now I'm just going back again. Now I'm doing a search. So what you have to do with Oanda, when you can't find a demo, is you have to do a scan, right? And now I'm scanning for this demo 4, because I guess it's a brand new demo, and it's not on there scanning. So I'm scanning for the whole thing, right? And the thing is, it's still not there. It's still not there, right? And you're like, right now, you'd be pulling your hair out. You're like, how do I log into this account if I can't find the right server, right? Because, and they won't tell you this. This is years of me knowing this stuff of how you do this. So even when you scan, you can't find the right server. What do? You actually have to physically, you copy that information that they give you in their backend. You physically add the server over here, press return, and then voila, all of a sudden, you're going to see that server coming up. Now, when it's a demo server, it's not that big a deal. But trust me, this happens with their real servers too. Like sometimes they'll give you a real server that's like, server 19, and it's not there because it's like a brand new server they created. It's not in their list, and you can't do it. So you have to literally physically input that into the list. And once you do that, then it's there. And then you just log in, and you see like, you log into the account with the, I think I'm just looking. I'm looking for this. I'm looking for the login number. See my great copy and paste skills over here. Type it in. And then I'm putting my password. And now I have the proper server, and boom, 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 and lo and behold, I'll give it a second. It's still holding in, but and there, behold, and now we got the account, and now I look at it and I go, oh, I got no money. I am logged in. I got no money. So what do I do next? Okay. So what I do next is, again, this is where Oanda really excels. I have no money in this MT4, and if this was any other broker, you'd be like, oh, I gotta get the money, I gotta transfer the money. All you gotta do is, if you have the money. By the way, this is true. Assuming you have 100,000 in a real account, you can do the same thing, right? Sorry, as you can see, I hit the wrong button. I have to go back. I have to go log in. What you do is you go find your main money account. You find your main money account, $100,000 account, and you say transfer. I'm going to transfer to that account. I'm going to drop like $10,000 into the account, right? It's all self-service. You see, like that's a super cool thing about the Oanda experience, is that it's all self-service. So we drop 10,000 into the account. We proceed, and now we go back to our MT4, and boom, I got the money instantaneously, and we're ready to trade. Right? That's pretty cool, right? That's really pretty cool, right? And then then I simply pull all the lists. I mean, this is just to show you that they trade CFDs. They have, so the not so good part about Oanda is they'll give you 1,000 symbols, and it's like really hard to find what you're looking for because now I've downloaded all the symbols they have. There is no rhyme or reason where the hell these symbols are located. So you can go into symbols and look at this. They have CFD, and within CFD you have like the Swiss group. Like what the hell does that mean? And then you have Group E, and then in the Group E you have Aussie and Bitcoin and the French CAC 40 and the DAX and all that stuff. So like looks like this is probably the group that you want with all the symbols that you want, right? It's not, none of this is horrible, but it just requires you really puttering around. This is why I say it's so important to play with a demo, get very, very comfortable with a demo. But here I think I finally find NASDAQ 100. I finally, I open up a chart, go to chart window. I keep hitting the wrong buttons. Now there we go. And you see NASDAQ 100 quoted and trading. And I think I actually trade this thing. Maybe, I'm not sure. And you have corn, and you have every other thing inside here. So then I go look for some other stuff. I think I look for the Group 9E. What does that? And remember that on your end, it's going to look very different. They're going to have Group 12 on your end. There's no uniformity as depending on what part of the world you are, what part of the server you are. You're going to have the instruments on different groups. And then that's part. I guess that's part of the MT4 aspect. But Oanda certainly doesn't make it highly intuitive. They don't really comment out where stuff is. So you got to really putter around to find what the instruments are. But they're all there. They're all there. You can trade everything. You can trade the Russell. This is the Russell. I was like, oh, I found the Russell. Let me see if I can find the Russell. And I think I was looking for the Russell. And here I find the Russell. I go chart window, and this is the Russell 2000, and I trade that. You don't see the benefit. It's not the benefit. It's their own nomenclature. None of this is for the benefit. Sanders says, I don't see the benefit of the negative E. It's what it's what they put on their server. It's their own classification. It's not for your benefit. It's for theirs, my friend. That's what I mean about the fact that they're having a hard time. So here, this is interesting. For some reason, I can't get in. I can't get in. I can't get in. I can't get in. And I finally just give up. Clearly, I think this is just definitely my fault. But I kept this in the video because I just sort of want to show you what to do. I think I know what it was. I get in and I trade the web. Sorry, I am able to trade the web, but I could not trade they have their own Java-based platform, and I just could not log into it. Now I can in my own real account, I can easily log into it. It was probably my own fault. But as you can see, their web-based platform, right? Very similar to FXCM's. So all of these platforms are the same. You get the quote panel. You get, now what's interesting is that Oanda actually has TradingView built in, by the way. So one hack that you can do is TradingView. Kathy said to you, TradingView is free. Yeah, it's free if you want to have advertisements splattered all over your chart all over the time. It's much better to pay for it. But if you don't want to pay for it, you can actually open an account with Oanda, and you can get that inside your platform. And and this, by the way, detaches, and you get all the functionality of the TradingView charting software inside the platform. So this is me banging away. For some reason, I could not. This is their Java-based platform, which I try to show you. I couldn't get it to work. So I just basically gave up and I closed the video. So let's kill this video because I think you guys got the you got the gist of what this thing does. And you see the positives of Oanda. The Oanda positives is incredibly good self service on the back end. Decent, the MT4, of course, if you're trading MT4, MT5, or MT4, they don't have MT5 yet, they have MT4, perfectly serviceable. Once you get comfortable with the symbol set, it's really easy to do, and it's all, it's all usable. The greatest advantage, the thing that I love about Oanda is the fact that I can open up any account I want, anytime I want, fund it instantaneously. run an algo on it, do all sorts of testing and everything else, and it's super easy. And as I said, a hack, sort of a hack to getting TradingView for free is to get an Oanda account because TradingView, it comes with Oanda as a platform. It doesn't have the full functionality of the one you pay for, but it's definitely enough, and it doesn't have any advertising, and it's super, super good. So the last video I want to show you, and I'm sorry, I'm going to keep you guys just a little bit longer than our 4 hours, but just bear with me. It's really worth it because this is sort of a very unexpected little discovery. Is this company called CMC Markets? It's a very, very big company, right? So we in America, of course, I can't trade this with them in America, but and this company does not have MT4 or MT5, so that makes it very, very different and unique because FXCM has MT4, MT5, Oanda has MT4, MT5, Pepperstone has MT4, MT5, or MT4. Just let's say MT4. And we're going to be talking about MetaTrader all the way through this course as we go forward because I'm a huge believer in using its tools and in using its algos to trade for it. So CMC has its own proprietary platform, right? Proprietary platform. Does not have MT4, MT5. So if that's one massive negative against the broker. But there's such huge positives here that are really interesting. So let me show you what they have. They have their own proprietary platform that is completely web-based, right? So this is the demo version of their platform. I'm just going to play it around with it. First of all, it's a really good platform. Like it's just, if you're like a web-based point-and-click trader, this is really well done. Really well done. It's super intuitive. I'm clicking. I think what I bought the Dow, right? I closed it up. You see that I bought a full unit of it. It tells you the P&L. I can click the X over here, and I get rid of the P&L. I close it out, and I can do the exact same trade in smaller size, right? So I close it out. I can do the exact same trade in smaller size. Instead of doing a full unit over here, I can do 0.1 unit, right? I can buy market. I can buy limit. It's all HTML5, but it's very slick. Very, very well done. And here I bought the much smaller, so my P&L is much more manageable, so on and so forth. I close this up, and my trading is done here. And then it has good charting. The charting is pretty good. It has the dark view and the light view. So I just choosing the light view. It defaults to a daily chart, but you can go to 1 minute, 5 second, gives you all the functionality. It has a whole bunch of stuff built into that platform that's, if you're a big technical guy, you really appreciate. Like, let me show you. I think it has drawing tools on the bottom here. It has time frames, all sorts of stuff built in. It has actually built-in pivot points, moving averages, like really built-in templates. Like you see how slick this platform is. It's super, super slick, right? Really, really clean. Everything is beautifully laid out. You can do all sorts of studies over here. And this is MACD. I'm putting MACDs on. I'm putting RSIs on. And obviously, this pops out, so it can be full screen. You can move to the next screen, so on and so forth. It gives you a full execution blotter of everything you did right away. Right over here, you see the full history, right? You can do price alerts if you want. You can set price alerts. You can see the history of all your trades. Everything done over here. Just slick platform. Now here's where it gets really, really cool. So it has a whole bunch of watch lists, right? And this, for example, this is the Dow Jones 30 watch list. So these guys were one of the original CFD brokers. And this is me struggling to make the window big. You'll see me just finally able to go full size. So here's what's so cool about this. Let me actually just kind of pause this, right? So because these guys make markets in any instrument you can think of, from any bond to any stock in the world, right? You can get free prices. You can get all the quotes you've ever wanted in your life without ever paying any money. Now, one of the things that I did not mention about futures is when you're trading futures, you pay commission, and you also pay what's called exchange fees.
You pay like $30 a month. It was 15, and they actually raised it out to $30 a month to just access Chicago Mercantile Exchange prices. In other words, if you want to trade on the Chicago Mercantile Exchange, which obviously this is the only thing you can do, you have to pay them like a VIG every month. The exchanges give you guaranteed prices, or they give you, clean prices, but they also make you pay money for it, right? And same thing, I think, with stocks. I think at this point, most of the brokers don't charge you, but they used to actually charge you money for it. But the thing is that if all you want to know is like where prices are of a whole bunch of instruments, first, or even if you have a U.S. account, do you really want to set up 30 Dow components into your trading account and just have it running all the time? These guys do it all for you. I mean, they have this already, pre-configured. And okay, maybe the price is 1 or 2 pennies off. It literally is 1 or 2 pennies off the underlying, but it's good enough because you're not trading for a penny. You're trading direction. The cool thing is now you can see, hey, who's the strongest? Who's the weakest? Who's the biggest mover? All this stuff totally for free, like completely in a clean format. If you have a multi-monitor setup, you can actually put it on a separate monitor. But the thing is, they also have these nice, beautiful tabs that you can just tab out and go into various instruments, and that's awesome. Like, I mean, as just knowing like what stocks are hot, which indices are hot, which currencies are hot, all of that stuff is awesome. You can obviously filter by change of price and everything else. You can go to popular price, and this is what's very cool. Here they give you everything. They give you the DAX, they give you the Dow, they give you the S&P, they give you the currencies. You can literally have everything in one single screen, and I literally do. I have I have like an old Dell, which actually is running Unix now, and I loaded this up just to see if it worked on my wide screen. It's beautiful. I have like literally every, and not only that, but I did this in like, you can subdivide the panels. So you could have one panel of like just populars, one panel of Dow, one panel of FANG stocks, one panel of indices and everything else. And it's giving you all these quotes for free. It's just pumping them out, so you could have like literally, even if you don't ever trade with CMC, it's just an amazingly cool little gathering spot of every instrument you could possibly imagine. Here's me, I'm just fooling around with charts, West crude oil, Texas. The one minor nuisance that I discovered is you can't drag and drop the like once it's, when you see these popular products, if I go to the product price, I can't change the order. I can delete stuff off the thing, but I can't change the order. I can't drag euro to the top of the heap, or drag the S&P 500 down to the bottom. But I can get rid of all the crypto stuff on the bottom. Also, look at this. I can also do a pop-out panel. So let's say I'm looking at all this stuff, and I'm focusing that oil is really moving, and I want to know, where the oil prices are. I can do this little pop-out window. All this, all the stuff that's working, and it's, it's awesome. I mean, it's 3 wide, it's 4 wide. This is, for somebody who just wants to know live prices, this is a gold mine. So you have all these different brokers, you have all these different platforms, you have all these different abilities to do stuff. The most important thing, obviously, is to go out there and try it yourself. But hang on a second. How do I? Here we go. But and I invite you, obviously, to download all these demos and work with them. But before I leave you, because I said I'm not going to do. We already went so far into the presentation. I don't want to keep you guys into TradingView. We'll do TradingView on Wednesday when I see you. I want you to kind of just remember the checklist before you open a real account. So here's my checklist of where you want to open an account. Is there a demo and have you tried it? That should be the first thing. You got to try the demo. You got to play with it, not just for like a minute. Play for it for a day. Trade with it. Read the documentation. Figure out how to do crazy stuff if you want. It's worth it. It's worth it. If you like it a lot, trade with it a lot. Like just get really don't practice on your real money. It's just not, there's nothing more annoying than making what I call platform mistakes. Trading is hard enough. You don't want to make platform mistakes. What platforms does it offer? Does it have MT4? Does it have MT5? Does it have its own stuff? Is it regulated? Really important. It's really important to know who is the regulator. Is there any settled complaints? Has there been, lots of customer dissatisfaction? It's a big red flag if there has been. It's usually a very good sign if there hasn't been. What's the policy for the deposit and withdrawal, right? Find out from their website. Does it have a 24-hour phone support? Some do, some don't. Call it, because even if they claim they have 24-hour support, if it takes you an hour for the guy to answer the phone, then he's as good as useless. Find out if they actually answer their phone in the first 5 seconds of the ring. Does it have dealing and STP? If it matters for you. Some brokers charge you inactivity fees. Inactivity fees are really annoying. Most brokers are very civil and they'll tell you, listen, you haven't traded with us for 6 months. If you don't place a single trade, we're going to charge you $50. Please place a trade, right? Some brokers are just assholes and they'll say, hey, you did trade with us. We just took $50 out of your account. You don't want that happening. You want to find out what the margin and the roll fees are. As I said, FXEM is super transparent with their stuff. Some brokers not so much. Is there any other fees that they're going to charge you? All that stuff you want to find out. It's the basic list to starting your journey on trading with a good quality broker. So I hope you guys enjoyed this. I think I've burnt my throat out at this point. I can't talk. I'm going to just ask, is there any final questions? Is there anything else that you guys have for me? And I'm happy to answer them. Or have I completely exhausted you at this point? So it looks like I've exhausted everybody. We meet again on Wednesday. I'm glad you guys really enjoyed this. Thank you so much. We will do sort of like a stubby little, hey, let's do trading station, let's do futures, let's do live. I'm going to show you all the live stuff, MT4, MT5 live, and then we're going to get into the very interesting idea of how to trade spreads. And you're going to understand why all the stuff that I showed you is kind of really valuable as a tool set. Thank you so much, guys. Thank you so much for hanging out with us. I will cut this video overnight, have it to you tomorrow, and then we will work on this into nice, tiny, as I said, digestible morsels over the next week or so. And so we'll post them into smaller bits and bytes. Hopefully you guys will enjoy that. All right, thank you so much, guys. I'll see everybody later. Take care.